In this course, you will learn the skills of successful stock market traders. After the completion of the entire course, you will be fully prepared for independent trading on the stock exchange. You will get all the necessary knowledge regarding gaining profit and how to protect from risk. In the last part of the course, we will present a complete strategy used by the most successful professional traders. Also, you will be able, based on the knowledge that you gain through the course, to combine various forms and tools of technical analysis and create your own strategy. This course is designed for beginners in the world of stock trading and also traders with experience. The learning process starts from primary and elementary things such as the basic thesis and terms related to the stock exchange, stock market operations, risk, profit. The following is an introduction to the trading and getting familiar with the trading platform. After acquiring this elementary knowledge, we will move on the detailed work in the field of technical analysis. Will be introduced trends, support and resistance levels, Fibonacci levels, Elliott waves, technical patterns, and the most dominant indicators and oscillators. Then we will explain fundamental analysis and sentiment analysis. In the final module, we will introduce our trading strategy, method of risk management, and money management. As you can see, the first module deals with the primary and elementary items. The aim of the first module is to present the terms on the stock exchange. The aim of the second module, which deals with technical analysis, is designed to prepare you for self-trading in the stock market. The aim of the third module is to enable students to self-trading in the stock market with a fully elaborated strategy. Okay, we can start with first lecture. Forex. The term foreign exchange market is connected to the Bretton Woods Agreement in 1944. This agreement established fixed exchange rates. The agreement was concluded between 45 countries, and the main motive of the agreement was the monetary and financial stabilization. In the same year, the International Monetary Fund was established, and the following year, European Bank for Reconstruction and Development was established too. After the collapse of the Bretton Woods system of fixed exchange rates in 1972, the country had to face with floating exchange rates. Floating exchange rates were suitable for creating foreign exchange market, which has attracted a growing number of investors and financial institutions. By 1996, the foreign exchange market could participate only large corporations, banks, investment funds, and institutional investors. Thanks to the development of information and communication technologies, the market became available for small participants. Here is where the trading in the Forex market as we now know it. Today Forex is the largest OTC market in the world. Daily turnover exceed 5,000 billion American dollars. This figure indicates that any market cannot even remotely be compared to the size of a Forex. Unlike other financial markets, where there is a limited time trading, Forex is open 24 hours a day, 5 days a week. The size of the market has made the Forex market the most liquid financial market in the world, which means that at any moment you can make your transaction buying or selling. If you're wondering why to invest money in Forex, we can cite a number of reasons. The first and most important reason is the possibility of high earnings. Yes, the truth is that Forex carries a certain risk, but in addition to mastering the skills of trade and a serious approach to trading, it is possible to minimize the risk and make a decent profit. So our answer is yes, join trading on the stock exchange. You probably think that trading on the stock market takes a lot of time and requires a great knowledge in the field of economics and finance, but the truth is different. Trading on the market is available to all of the people. It doesn't matter if you haven't had any previous contact with finance or if you are not an economist, and it is not required to have a high school and college. Also, if you want to do stock exchange, Does not mean that you have to give up your present job. But if you want success, it is necessary to take seriously access to the stock market. Regarding the fact that trading takes 24 hours every day, you have the ability to customize your own time, which means that you can trade in the morning, afternoon, or in the evening. Of course, you can combine the time. The biggest advantage is the ability to access Forex from your own home, from your PC, in the office, or anywhere where you have internet access. Trading platforms are available on computers but also on smartphones in the form of applications. So trading on the stock exchange today is accessible to all. As already mentioned, the Forex market is very liquid, and of course knowledge you gain on the Forex you can apply to any financial market, like the stock market, indices, future market, options, commodities, and etc. Who are the participants in the Forex? The participants in the Forex market are the state, central banks, institutional investors, banks, large corporations, companies, and individuals. When we talk about the division of the participants, there are different criteria of classification. The most important division sure to dealers, brokers, and clients. Who exactly is the broker on the Forex market? Brokers are intermediary companies providing brokerage services in the global financial market. Also, in addition to brokerage services, a Forex broker is obligated to provide to their clients information regarding the trading on the stock exchange. A Forex broker make their profit by charging a spread, which represents the difference between the buying and the selling price of a currency pair. Besides that, brokers increasingly offer services regarding trading in financial derivatives such as futures, CFD contracts, commodities, and stock market indices. Small traders could not access stock exchange without any broker intervention. Brokers enable small traders trading by deposits of traders on brokers' account. A client access the stock exchange via personal account received from broker using trading platform. Who is the dealers on Forex? Dealers are market participants who trade on their own behalf and for its own account. In foreign exchange, it is a major market players such as Deutsche Bank, Citigroup, JP Morgan Chase, Goldman Sachs, Merrill Lynch, etc. Thanks to the dealers, Forex market reaches its maximum liquidity. Capital control by these players as well as the volume of the transactions are reaching extremely high amounts. Their power is measured in the billions of dollars. As a result, the Forex dealers have greatly influence on price movement. They have the power of moving the entire market. Who are the clients? Clients usually include two groups. The first group consists of customers who want to protect themselves from currency risk and they call us hedgers. While a second group are speculators and their only goal is to make a profit. The most significant clients include corporations, hedge funds, insurance companies, pension funds, other financial institutions, and the population. Okay, we can move on next slide. The most traded currency pairs. The most traded currency pairs in the foreign exchange market include Euro US dollar, US dollar Japanese yen, British pound US dollar, Australian dollar US dollar, US dollar Swiss franc, and US dollar Canadian dollar. In addition to these, there are many other currency pairs. Besides displayed currency pair, brokers offer a trade with exotic pairs such as US dollar Hong Kong dollar, US dollar Danish crown, US dollar Mexican pesos, and etc. Characteristic for these pairs is that spread for them is mainly a lot higher than spread for the base pairs, because the volume of trading in these currency pairs is much smaller. Depending on the broker, there is a different number of currency pairs to trade. with a variety of spread and commissions. Also, there are brokers who can offer trading oil, gold, silver, indices, stock, futures, options, and etc. Trading platforms. To access trade on the Forex, you need to open an account on a brokerage house and download the trading platform. The basic element of the platform is a graph which showing the movement of the prices. On the chart, there are many tools used for trading. The most common and most widely used platform is MetaTrader 4. Almost all brokers have this platform in their offer. Platforms can be downloaded on the website of the brokerage house when you open your account. Speaking of that, there are two types of accounts, demo account and professional account. For beginners, it is recommended to start with a demo account in order to acquire the necessary minimum skills before opening a real account. In addition to the MetaTrader platform that we have mentioned, there are other platforms that you can use for technical analysis. We will show you TradingView and FxGhani Scope trading platform. First, we'll show you the platform MetaTrader 4.
On the left side of the platform are shown currency pairs, indices, CFD, and other financial instruments with which you can trade. As you can see, each currency pair or financial instrument has its own bid and ask prices. These are buying and selling prices of financial instruments. Bid and ask price will be discussed later on. The next field is located below the field of financial instruments and contains account information, programs for trading, and indicators that can be externally inserted or deleted. These indicators of technical analysis used in trading will be explained more detailed in the next module of the course that is dedicated to technical analysis. The chart includes the largest part of the platform and its settings can be managed with tools that are about chart. Data on the account balance, open positions, gains, losses, trading history, etc. are located in the lower part of the platform. The biggest advantage of this platform is the simplicity of its use. Now we will present a platform for XCM Trading Station Market Scope. This platform is downloaded from the website forextrading.com. When you access the site, select the practice account. It is necessary to fill out all required information. This data can be fake, only email must be correct since you will get a certificate of registration and your username and password to use the platform. After you fill in the information, you can choose between two options, web platform or desktop platform. If you choose the desktop option, you will access to installing the platform. Since we use the desktop version, we will show you how to access the platform. The first part of Trading Station includes a box with all currency pairs, filled with information about the account, open and closed position, as well as messages and news. As you can see, unlike MetaTrader 4, ForexCM does not have graphs, but you can open chart by right-clicking on the one of the available currency pairs and choosing Open Chart and time frame of your choice. We will open graph. Chart is opened in another large section, which is called the Market Scope 2.0. The advantage of this platform is this chart because it offers more options for technical analysis in the form of indicators, oscillators, and other tools for drawing on the graph. The ability of the move graph, and also the platform is extremely transparent. In addition to these two platforms, we introduce another extraordinary platform. It is the TradingView online platform. Unlike the previous two platforms, you do not have to open an account with a broker. Platform access is free via the internet site www.tradingview.com. The biggest advantage of this platform is online access. The platform is exceptional in terms of technical analysis tools that it offers. Also, many traders publish their analysis, which can be extremely useful for the beginners. When you access the site, in this field you enter shares, currency pair, index, or other financial instrument you want to analyze. We will enter, for example, the Euro US dollar currency pair. Unlike previous two platforms, here we have no information about the open and closed position, account, trading history, because this platform is used only for analysis, not for trading. The platform provides a number of indicators and instruments for technical analysis, as well as a large number of financial instruments that are primarily related to the stock market. During this course, analysis will be carried out on the MetaTrader 4 and TradingView platform. Basic terms in trade. Before you begin trading on the stock exchange, it is necessary to learn the basic terms and the concept used in trading. These concepts include a currency pair, chart or graph, time frame or time zone, pips measuring unit on the stock market, leverage or financial levers, spread or brokerage commissions, lot size of stake, long buying position, short selling position, stop loss, loss option limits, take profit limit gain option, bid price, and ask price. In addition to this basic concept, there are other that will be explained when we move on the more detailed workbit platform for trading, and that is when we go deeper into a process of analyzing currency pairs. We will now explain each of these concepts a little more detailed. Currency pair. The pair is a financial derivative that consists of two national currencies. The first currency in the pair is called the base currency, while the second is called quote currency. Trading with one currency pair still implies two transactions, which means when you buy the base currency in the pair, that automatically means that you sell quote currency or other currency in the pair. Buying or selling a currency pair is always related to the base currency. What does that exactly mean? If we say that we bought the currency pair Euro US dollar, it means that we bought euros and at the same time sold dollars. And if we say that we have sold the currency pair Euro US dollar, it means that we sold euro and at the same time bought dollar. Charts. Charts or graph represents the desktop where is presented the movement of a certain currency pair or any other financial instrument. There are several different charts on the stock exchange. These are line charts, bar charts, and candlestick charts known as Japanese candles. Now we can move on trading platform to show these three types of charts and point out differences. Line graphs represent the price movement shown by one line. Any closing price or opening price within, for example, 1 hour or 1 day is one fixed point. When these points join at the one line, that line represents the price movement of a currency pair. Line graphs are rarely used because they could not show movement within a specific period of time. For example, if we look at the daily charts, the price movement within a day is shown with only one point. The following forms of charts are bar charts or column charts. A bar chart is slightly more used than line charts because they show the highest and lowest value within an interval. And the opening price is represented by a drawable line on the left side of the diagram, and the closing price is represented by a drawable line on the right side of the diagram. Also, this chart, as the previous one, is not so popular among the market participants. The most used charts in the market are Japanese candle. Similar as the bar charts, Japanese candles show the highest and the lowest price, as well as the opening and closing price for a specific period of time. The difference compared to the previous chart is the body of the candle, which is rectangular shaped and represents space between the opening price and the closing price. The body of the candles is painted in different colors depending on the direction of prices. Now let's get back to our slide. The first candle is green, which means growth of the value within the time interval, which can stand for 1 minute, 1 hour, 1 day, or other. The body of the candle is formed of a rectangle and two vertical bars, one below and one above the rectangle. Top upper dashes indicates the highest price observed during this interval. The bottom dash indicates the lowest price of a currency pair during this time interval. The bottom line of the rectangle represents the opening price, while the top line of the rectangle represents the closing price of the observed currency pair in that time interval. Another candle is red, which indicates a fall of the value of that currency pair. As previous candles, dashes represents the highest and lowest value of the movement of a currency pair in that time interval, while now the top line of the rectangle represents opening price of the currency pair and the bottom line of the rectangle represents closing price of a currency pair in that time interval. We can go back to the platform in order to see the Japanese candles on graphs. On our graphs, candles are framed in green, while the bodies of the candles whose interval represents growth are gauzy, and bodies of the candles whose interval record fall are white. Depending on intensity of price movement during a time interval, candles have different size and shapes. If you notice that candle's body consists of a single line, or if the candle is reminiscent of a cross, it means that the closing price and the opening price are the same for that time interval. However, if you notice that dashes above or below the candle's body not exist, it means that the opening price and closing price is the highest or lowest value for that time interval. Time frame. Time frame is the timeline for trading. Time frame will depend on the trader and his strategy. Traders who trade in the short term mainly target smaller profits with a large number of positions played by the day or week. They commonly use shorter time frames such as M1, M5, M30 or H1, while traders that have less trading volume and hold longer their position open mainly use larger time frames such as H1, H4 and day 1. If you go to the platform options for changing the time frame, above the graph they show the following markings. M1, which means 1 minute. In this time frame, each candle represents the price movement of 1 minute. M5, which means 5 minutes, represents the movement within 5 minutes. M15 represents the movement within 15 minutes. M13 represents the movement within half an hour. H1, movement within 1 hour. Then a candle represents movement within an hour. H4 represents movement within 4 hours. D1 represents movement during 1 day. So one candle represents the movement of price in the 1 day. W1 means that candle represents a movement in 1 week, and MN tells us that one candle represents the movement within 1 month. Pips is the basic unit that expresses the change in currency price. If the graphics have 5 decimal numbers, as in our case, the fifth decimal place is called ticks. 10 ticks represent 1 pips. Pips represent fourth decimal place of the currency pair value. If the currency pair euro US dollar is worth 1.14355, that means that 1 euro is worth $1.14355. Or if measured in pips, euro US dollar currency pair is worth 11,435 pips, aka 114,355 ticks. If the value of the euro rose from 1.14355 to 1.14385, this means that the value of the euro rose by 3 pips against the dollar. In contrast, if the value of the euro fell from 1.14355 to 1.14325, this means that the value of the euro fell by 3 pips against the dollar. Financial leverage allows small investors to drastically increase the level of their investment. For example, if you invest 100 euros in Forex and use the leverage 1 per 100, you're actually trading with the amount of 10,000 euros. Financial leverage is an extremely useful tool. Without the small investors would not be able to access trading. However, one should be careful when it comes to leverage. A ratio of 1.100 increases not only the potential profit, but the same ratio increases the chance of potential loss. Depending on the choice of broker, different leverage are offered. The most common brokers offer leverage is 1 per 50, 1 per 100, or even 1 per 500. Spread. Spread represents the brokerage commission. Every time when you open a position, the broker charges spread. Spread is also referred to as the brokerage margin. It represents the difference between buying and selling prices. It is defined for each currency pair. Now, since the spread is different for different pairs, clearly the question is what determines the value of spread? Spread is determined by the ratio between supply and demand. The larger the volume of demand for a particular currency in the market affects the movement of currency pair that contain the currency, and so the height of the spread increases for this currency pair. In some situations, spread can grow even several times. These are the most common situations when publishing significant news related to interest rates, inflation, monetary policy, and so on. Although the fluctuation or increase of demand for currency pair affect the growth of spread. In general, the lowest average spread have currency pair with the highest trading volume. For example, the largest trading volume has the euro US dollar pair, and depending on the broker, spread can oscillate around 1 pip. While some exotic pairs, which are much less traded on the stock exchange, have spread over 20 pips. What does this mean for the trader? This means that it is much more profitable to trade with most traded pairs because they will be paid lower broker's commission or spread. Spread is calculated instantly as we play a position. And we can see that by noticing that we are starting this position with a small minus. The minus is the price that we pay for the services broker provides on the stock exchange, and that amount depends on the amount of spread. We will have an insight into the spread value when we explain the ask price. Lot represent the size which measures the amount of money we invest in each trade. One of the standard lot size is 100,000 US dollars. In addition to the standard lot, there are mini lot that is 10,000 US dollars and micro lot that is worth 1,000 US dollars. The amount of lots we entering by clicking a new order, and then in box volume the amount that we invest in our trade. In the drop down menu we have offered volume of lots at least 0.01. That means one micro lot and up to an amount that allows the size of the deposit and brokerage leverage. For example, if we want to enter a trade with 3,000 US dollars, we will enter 0.03 in the box volume, and that represents 3 micro lot. Long position. Long position represents a buy position on the market. For example, when you buy the currency pair US dollar, you are in a long position in this pair, and it can be said that you are in long euro against the dollar. A short position represents a sales position in the market. For example, if you sell the currency pair euro US dollar, you are in short position, or we can say that you are shorting euro against the dollar. Stop loss order simply means an order by which a trader limits his loss. We can say that the stop loss is one of the most important options that is used in trading, especially if you're beginners. If the trader has decided to enter into a long position or particular currency pair, he will set a stop loss below entering level in order to protect from unexpected drop in prices. Or on the contrary, stop loss will be placed above the entering level when he wants to enter the short position or sell a currency pair in order to protect against unexpected growth of price. In addition to stop loss, traders often use the take profit order. With this order, traders take profits, or platform automatically close the position when the price reaches the desired level, which is determined by a trader based on his strategy or analysis. Take profit is always above the current price if the trader is in a long position. On the contrary, take profit is always below current price when the trader is in a short position. Now we can move on the platform to show how to set stop loss and take profit orders. Since the stop loss and take profit orders are placed only when we want to play a position, you need to click on the new order button. When we open a new window, first we choose the symbol with which we trade. In this field is usually symbol of the graph which we have opened, followed by the volume box. In this field we enter lots or the amount of funds that we invest in our trade. They are followed by the field stop loss and take profit. For example, if you trade the currency pair US dollar Japanese yen and we believe that it will grow, stop loss will be placed below the current price. If the current value of a dollar is 119 yen, as we can see, and we believe that it will not fall below 150 yen per dollar, and we expect, based on our analysis, that it will grow to 125 yen per dollar, then we will enter price of 115 in the stop loss field, and the amount of 125 in the take profit field, and then click on the box buy by market. If the price starts to fall and reach the level of the stop loss of 115, position will automatically close and we will finish the trade with a loss. On the contrary, if the price starts to rise and reaches the desired level of take profit of 125, position will be automatically closed and we will finish trade with a profit. This was the case for a long position, and now we will do the case for short position with the stop loss and take profit orders. The principle is the same, except that now we expect that the currency price US dollar Japanese yen to fall. So if the current price is 190 yen for $1 and we believe that it will not go above 125 and we expect it to fall to a level of 115, in the field stop loss we will enter the amount of 125 and we will enter amount on 115 in the take profit field and then click the box sell by market. If the price rises to 125, we will finish the trade with a loss. But if the price falls on the 115, we will achieve the profit. We will click on the button New Order once more time to show Type field, which means order type. In a drop-down menu, there are two types of orders, and these are Market Execution and Pending Order. Market Execution means selling or buying transactions at the current price, as we did in the previous two examples. Another type is Pending Order. Pending order represents a price above or below the current price from which the trader wants to get into position. Then in field type, he must select the type of pending order, and then in field add price, enter the price from which he wants to activate position, and then click on the button place. Also, as with market orders, we can set the take profit and stop loss orders. Trading with the pending orders will be explained in more detail in the last part when we do trading strategy harmonic pattern. Ask represents a requested price at which a trader can buy a currency pair, while bid represents the offered price for the traded currency pair. The difference between bid and ask price is called the spread. In the MetaTrader 4 platform, on our chart, you can see a gray line, and it represents bid price. If you want the graph to display ask price also, and therefore see what is spread on the reporting currency pair, place mouse on the graph, click the right mouse button, and in the offered menu, select the last option properties, and then choose a common, and then choose show ask line. Ask price is shown as a red line on the graphics, while the bid price is displayed with a gray line. Deviation, gray line of the red line represents the spread. Analysis used in trading. In trading on the stock exchange, there are three types of analysis in use. The first analysis is technical analysis. What does that mean? Technical analysis means predicting price movements based on past experience. So predefined templates that represents price movement through history are used, and based on these patterns and probability of their occurrence, traders define expectation regarding the future price movements. Fundamental analysis defines the global direction of price movements, involving factors such as macroeconomic impacts, political events, nature, etc. Small traders follow fundamental analysis through information published in the form of economic calendar and the different sites like Investing, Bloomberg, Reuters, MarketWatch, and other. Sentiment analysis is a subjective feeling of traders on the future direction of prices. The combination of ideas, attitudes, opinions, and emotion of all participants in the market represents market sentiment. In the following module of our course, we will explain technical, fundamental, and sentiment analysis. Pending orders. What does it mean, pending order? Pending order is option that we use if we want to enter the position at a certain level of price that is below or above the current price. Depending on whether we are entering into a position above or below the current price, and whether we enter the buy or sell position, we distinguish four types of pending orders. Those are buy limit, sell limit, buy stop, and sell stop. Now we will explain each of these pending orders specifically and show how to set them up on a platform. We will start with the first example, buy limit. It's the currency pair US dollar Japanese yen. If we want to get into the buy position at a price of 118 yen per dollar, and we do not want to spend time constantly keeping track of changes on the platform, waiting for the price to fall to the level of 118, we will place buy limit order. And if the price falls to the level of 118, platform will automatically activate our position. Now we will show you how to set a buy limit order. We will first click on the button New Order, and in the field type, choose Pending Order. In the field type from the drop-down menu, we will select Buy Limit. In the fielded price, enter the target price. In our case, it will be 118. Then we will enter the stop loss, take profit and volume. The volume will be, for example, 0.2 lots. In any case, this field depends on each individual trader and you determine how much you are going to risk with your trade. Just to mention, the most professional traders do not risk more than the maximum 2% per trade. Stop loss will be, for example, 115 and take profit 125. Then you need to click on the place button. Now the graph shows two red and one green line. The green line is our buy limit order. If the price falls to that level, position will be activated and we will be in buy position. If the price falls and hits the stop loss, we finish trade with a loss. But if the price increases from our level and hits the take profit, position will automatically close and we will finish the trade with a profit. However, if we make a mistake in placing an order and want to delete our account, just click twice on account that we see at the bottom of the platform, select a pending order, and then make changes or click on delete to delete your pending order. We will now delete this placed by limit order to set another options of a pending order, sell limit. Sell limit order is placed when we want to enter into short position of a desired level which is above the current price. For example, if we want to get into sell position on the level of 125 yen per dollar. Okay, let's start setting up our account. New order, pending order, then choose sell limit. In the field at price, enter the number 125. We will set up a stop loss at 128 and take profit at 120 and then click on the place button. Now we see again the three dashed lines. The green line is our sell limit order, the upper red line is the stop loss, and the lower red line is our take profit. If the price jumps up to our stop loss, we will finish trade with a loss. But if the price falls and hits the take profit, trade will be end with a profit. Of course, if you want, you can finish trade earlier before the price hits the stop loss or take profit. This can be adjusted by double clicking on the open position and then click on the close button. Given that our position is not open, we do not have that option. We have only the option to delete this pending order, which we are going to do. It is necessary to point out that pending orders are widely used in trading strategies that are based on patterns of technical analysis, and especially in trading strategy with harmonic patterns. Besides these two, there are two more pending orders, the buy stop and the sell stop order. These orders are placed in situation where we think that the price will continue the moment if the price breaks through a certain level. For example, if we believe that the price will continue to rise if it reaches the previous top, then we will set up a buy stop order. Or if we believe that the price will continue to decline if it reaches the previous bottom, then we set up the sell stop order. As in the previous example, we will present graphically what is the expected movement when we set up a buy stop order. We will click on a new order and then pending order and select buy stop. In the field price, we will enter desired level. In our case, that is 125. Stop loss will be set up at the level of 122 and take profit at 128. And we click on the button place. Now we can see our buy stop order. If the price jumps and exceeds the level of order, our position will be opened. If the price continues to rise and reaches our take profit, our trade will be closed with a profit. But if the price jumps, open our position and then fall, the trade will be end up with a loss. We will delete this account and explain the last sell stop order. For example, if we expect that the price will continue to decline when it reaches previous bottom, we will set up a sell stop order. Okay, let's present that graphically. Click on the button New Order, then Pending Order, and then select the sell stop. In the filled price, we will enter the amount of 118. Stop loss will be set at 120 and take profit 114. And then click on the Place button. On the graph, we see the following. A green line is our sell stop order, then will be activated if price falls to a level that we have set up. In our case, that is the level of previous bottom. If prices continue to fall and hit the take profit, we will achieve the profit. But if the price is back up and hits the stop loss, we will finish trade with a loss. This would be all as far as it concerns pending orders. Just to mention that we use stop loss and take profit options in the examples. Of course, you do not have to use them. These orders can be placed without a stop loss and take profit, but our recommendation is to use them. If you don't want to use take profit, then at least use a stop loss option. Hello everyone, welcome to the part of course which will deal with the technical analysis. Technical analysis is based on an analysis of the movement of price of certain financial instrument through history, and based on that analysis, predicting price movement of the same instrument in the future. A very important aspect of technical analysis is the study of human psychology and the psychology of the masses. What do we mean by this? Since technical analysis is used on the stock markets for over 100 years, traders have established certain patterns that indicate certain directions of price movement after the formation of these patterns. Since these patterns are used in stock exchange for a long time and have given good result previously, traders are considered that this trend will continue in the future. This means that when one of the known forms of technical analysis, for example head and shoulders, form on graph, a large number of traders who use technical analysis begin to think the same and enter the same position after this pattern is formed. This tells us that using the technical analysis, we can presume the opinion of the masses. It is especially important to understand on the Forex market because it's decentralized, and as we mentioned in the previous part of the course, there are very big players on the Forex market whose trading volume may affect the direction of price movement and therefore turn the psychology of the masses in their favor. Besides these patterns, technical analysis involves the use of specific tools as well as the oscillators and indicators which are obtained by mathematical processing of data regarding price movement. Technical analysis is usually used for evaluating short-term price movements, although it can be effective to determine the long-term direction of price movement by combining with fundamental analysis. Before we explain the use of patterns and tools of technical analysis, it is necessary to say something about the price movement on financial markets. What we are talking about now is the basis of technical analysis, which is still widely used, and without them technical forms would not make any sense. Of course, we are talking about trends. Trend represents the direction of price movement. It is visually noticing, and depending on the direction of price movement, it can be uptrend, downtrend, and sideways trend. Although we can conclude what kind of trend is just by looking at the graph, there are certain rules that are specific to each type of trend. As we can see in this graph, it shows a growing trend or uptrend. Now we can move on the picture that show a growing trend and say something about its features. First, we need to say that we can observe trend at all time frames. It depends on our strategy, trading strategy, which trend we are going to observe. Although there is a rule that the main trends are observed at the longer time frames, and these trends are formed for several months or even several years, while smaller corrective trends we observe in smaller time frames, and they last for a period of several days to several months. The main characteristic of the growing trend is that each new bottom which is being formed should be higher than the previous. In this picture, we see that numbered 1, 2, 3, 4, and 5. Each new bottom is higher than the previous. Another characteristic of the growing trend is that every new top that is formed is higher than the previous one. In this picture, we see that market with letters A, B, C, D, E, and F. As long as each new bottom and top is higher compared to the previous, it is considered that the trend is still strong and that will continue. So traders should place their position in accordance with the movement of the trend or should take buy position. The first sign that the trend is weakening and will perhaps come to a trend reversal we can see in point 6, where we see that the previous bottom, marked with the number 5, is broken. This situation indicates that traders should consider taking a sell position in this financial instrument in the upcoming period. We will now show a downtrend. The essence is the same as with the growing trend, but in this case each new bottom is lower than the previous, and each new top is lower than the previous one. As we see in the picture, bottoms or lows are marked with letters A, B, C, D, E, while the tops or highs are numbered 1, 2, 3, 4, and 5. Point 6 showed the breakthrough point of the previous peak, and that gives the first indicates that the decreasing trend is weakening and will perhaps come to a trend reversal. There is another type of trend, and the trend is called sideways trends. The characteristic of this price movement is that the price is moving in the framework that does not have specifically defined growth or fall. The highs and lows are not formed by any rules, and for this reason for traders it is very difficult to determine in which directions the price will go. This is the main reason why many traders avoid trading with those currency pairs and other financial instruments which trends cannot be determined.
When we talk about a trend, it is necessary to explain the trend lines and channels. The trend line represents a line that is obtained by connecting at least 2 points within the existing trend. The trend line represents support and resistance levels. What are the levels of support and resistance? The level of support is a zone below the current price from which we expect growth of price. The resistance level is a zone above the current price from which we expect fall. Evaluating of support and resistance levels is made with the help of forms and tools of technical analysis, and it is important to note that the level of support and resistance should be observed as a zone, not as a precise point. The trend line may represent a level of support and a level of resistance. We will explain that in the following picture. As we said, the trend line is obtained by connecting the bottom points in the growing trend. It provides support levels for us, and we believe that the price will deduct from this line and continue the original trend. Levels of the trend line represents the signal to enter the buy position. Point 3, 4, and 5. while the stop loss orders should be set up below the previous lows. For example, if we decide to enter into a long position in point 4 when the price hit the trend line, we should set stop loss order below the previous low, mark it with number 3. Once the trend line is broken, as we can see in point 6, then the trend line becomes the resistance lines from which we believe that the price will deduct and begin to fall, as shown in point 7. The same principles prevail in a downtrend, only then the line will be obtained by connecting the highs, and then the trend line would represent a line of resistance from which we expect the fall in price, until one day it would be broken and became a support line. We can move to the platform and open currency pair Euro US dollar to see if we can find here the trend line and also support and resistance levels. We see that at H4 graph is showing uptrend. Okay, we will connect the two bottoms and get the trend line. When the price comes close to our trend line, we had a buy signal. As we see, the price has jumped from the trend line and made growth of about 160 pips. This growth did not last long, and price soon returned and broke through our trend line, and as we said, now for us this is a resistance line from which we expect the fall in price. What happened next? The price has approached to the trend line and now we have a signal for short on this currency pair. This does not mean that the price will certainly drop from this level, but with the fundamental and other tools of technical analysis, we can expect a drop in price from this trend line. As for the channel, we can say that they represent two nearly parallel lines. One line is obtained by connecting the bottom, while the other by connecting tops. In the picture we see the channel in a growing trend that we obtained by connecting points 1, 3 and 5, and this line represents the trend line. The second line we get by connecting peaks 2, 4 and 6. This channel we could draw earlier when we only had 2 peaks and 2 bottoms on the graph, or when we had only points 1, 2, 3 and 4. The space between these two lines represents the zone between the price moves. The bottom line represents the support line and provides signals for buy, point 5, while the upper line represents the line of resistance and gives signals for short, point 6. Although the price may long oscillate within the channel, there are similar rules as for trends that tells us that the price will leave clearly marked zone and reverse the trend. The first indication of this is shown in point 7, where we see the top did not reach the upper line of the channel, neither to break the previous top. This tells us that the price does not have the strength to carry on with initial rising trend, and there is a chance that the price in next turn maybe break the bottom line of the channel, and in this case it is not wise to enter the buy position. As we see, this has happened in point 8. Price is not only broke through the channel line, but even more quickly exceed the level of previous bottom, and this is clear sign that there could be a reverse in trend. Hello everyone, in this lecture you will become familiar with one of the most useful tool of technical analysis, Fibonacci. Fibonacci is used to measure the price return and extensions. Regardless of the strategy, almost every professional traders use Fibonacci in his analysis. Traders rarely use it as the only tool in his analysis, but they are usually used in combination with other tools and forms, and it's pretty amazing how often it can provide a precise entry in the position. First, let's talk about what is Fibonacci sequence and golden ratio. A Fibonacci sequence was discovered by famous mathematician Leonardo Fibonacci in the 13th century. Looking at the relationship in nature, the scientist has found the existence
of certain principles. These principles or rules are linked to the existence of dimensions with different shapes and relationship. And relationship are shown mathematically as the difference between the next and the previous number. And here is done Fibonacci principle. The rule reads as follows: next number equals the sum of the previous two numbers. The mathematical representation of this relationship is 0 plus 1 equal 1, 1 plus 1 equal 2, 2 plus 1 equal 3, 3 plus 2 equal 5, 5 plus 3 equal 8, and so on. Analyzing relationship among numbers, he came to a remarkable conclusion. After the number 55, the relation between any subsequent two numbers continuing the string is 1.618. And this is the number which is called perfect relation or the golden ratio. It represents an important item for trading on the stock exchange. Now we will show you curiosities where the aforementioned rule recognizes, and we will point you to the important relation Fibonacci sequence in nature and all around us. For example, this relation is evident in the form of spirals. The most common example would be a snail or a human hair. Circle that expands and forms a spiral is larger than the previous for about 1.618. Also, the observation of sunflower blossom are clearly visible spiral relation within the flower heads. The following example is related to the observation of the human body. It may be noted that the upper part of the body, from the middle of the waist to head, includes approximately 38.2 of the total body height of a man. The remaining part of the body comprises approximately 61.8 of the body height. These two relations are also derived from the Fibonacci sequence. In addition to these examples, there are assertions that the whole universe is made through this relationship. A system of planets, galaxies, stars, and other universe objects and their dimensional relations confirm the existence of certain rules that are reminiscent of the Fibonacci principles. An interesting example is the famous painting by Leonardo da Vinci, Mona Lisa, whose relationship head and torso to the arm is in dimension of the golden ratio of 1 per 1.618. These principles are still very much applicable on the stock exchange. Many years of research found that length of the price movement in mutual opposite directions occur in a proportion that is equivalent with Fibonacci numbers. The essence of the forecasting techniques of price movement based on Fibonacci numbers represent the ratio of the length of the previous price movement and the current price movement in the opposite direction that we want to predict. We can move to the platform and present to you basic settings related to the Fibonacci on the MetaTrader 4 platform. After we have opened the platform, we will show you how to activate the Fibonacci tool. In the upper left corner, click on the Fibonacci icon. After clicking, there is a change in appearance of our cursor. This means that the Fibonacci is activated. If you want to turn off Fibonacci, right-click on the chart. The cursor returns to its original state. If we want to stretch the Fibonacci, click on the desired place to pull in a certain direction, and the Fibonacci will be displayed. If you want to delete Fibonacci, click double time on the red dashed line, then right-click and select Delete option. We will click again on the Fibo tool. Fibonacci always extends from left to right. When we measure the growing trend or a rising wave, we extend Fibonacci from bottom to the top. When it comes to a falling or declining trend, we stretch Fibonacci from top to bottom. Look at the following example. It's a movement of Google share. When we stretch Fibonacci from the top August the 26th to the bottom September the 2nd, we notice three significant levels of resistance. At the level of 50%, 38.2%, and 61.8% Fibonacci retracement. First, it is necessary to introduce you to the two types of levels that we are actually measuring. These are levels of retracement and levels of extensions. What is the level of retracement? We have just demonstrated level of retracement. Each of the presented levels of retracement represents resistance for the price, and the reason is that we measure the drop-down wave, but in the growing trend, the levels of retracement represent support from which it considered that the price will continue in the original trend. Now we stretch Fibonacci from the 3rd to the 9th of September, and we see significant resistance around 50% level of retracement. In this case, the 50% level of retracement represents the support from which the price rebounded and continued to grow. We'll show you again in another currency pair. Let it be British pound US dollar. We extend the Fibonacci from the bottom April the 13th to May the 14th. At the level of the 50% retracement, we see significant resistance. Remember, retracement is measured by stretching the Fibonacci from the bottom to the top when it comes to the growing trend, and from top to the bottom when it comes to falling trend. Uh, in example, so far we have shown support and resistance levels on the key Fibonacci levels of retracement. The most important levels of retracement are 0.382, 0.500, 0.618 and 0.786. In next lecture we will explain in detail each of these retracement levels. The first important level is the level of 0.382 Fibonacci retracement. It is the first potentially significant level of support in a growing and resistant level in a downtrend. This level is important, but not as much as level of 0.500 and particularly level of 0.618. Often the price continues the main trend from this level of retracement, but why do traders often avoid to make entry at this level? Well, the reason is simple. That would mean that the stop loss would be placed below the 0.500 level of 0.618. Therefore, the ratio of their risk profit would increase, so they rather decide to make the entry on the lower levels of retracement. Trading with 0.382 Fibonacci retracement is recommended only when we have a strong trend. In situation where the purchase overcomes sales, the price of a currency pair increases. Bull traders who cause the growth in price of this currency pair have position in profit. When one part of the bull traders decide to close their position and take the profit, then they automatically weaken the bullish side and the price begins to fall. When we have a strong trend or when there are some positive news from the fundamentals, then that fall often goes only to the level of 0.382 retracement and then continues the original trend. In this situation, making an entry at 0.382 is absolutely justified, especially if around the same level there is, for example, trend line, channel, or some other form of technical analysis, or divergence on some of the indicators, as well as additional confirmation to enter the position. Another significant level of Fibonacci retracement is 0.500 or 50% Fibonacci retracement. This level of retracement is the point of balance between bullish and bearish traders on the market. If the conditions are met for buy or sell at this level, it should be done on a short-term basis. This is exactly the reason why many traders do not want to set position at this level, because at this point it can easily come to a trend reversal. Also, for traders are more profitable to wait for the price to test the level of 0.618, because in this way they reduce their level of risk. As we said, entry at this level should be made only with confirmation of other tools and technical analysis or indicators. Next level of Fibonacci retracement is 0.618 or 61.8% Fibonacci retracement. It is the most important Fibonacci level of retracement. It represents the reciprocal value of 1.618 Fibonacci extension or number that is called the golden ratio. This level of retracement represents a kind of psychological barrier. Why do we say this? The majority of traders were uncertain to enter the position in the previous levels, so they do that now. Traders who trade in the direction of the main trend enter position only in some of the Fibonacci levels of retracement with the help of other technical tools. According to the many traders, this level represents an ideal opportunity to enter the position in the direction of the main trend because they believe that the price has already made a great return and that it will come back to original trend. Another important reason why traders prefer this level is that they have a much better ratio between risk and profit compared to the previous Fibonacci levels of retracement. Of course, this ratio of profit and risk is even better on the 0.786 Fibonacci retracement, but then there is a much bigger chance the trader missed the trade because the price might not reach this level. 0.786 level we do not have yet, and we will enter it now. If you extend the Fibonacci, you can spot the existence of levels of 0, 23.6, 38.2, 50%, 61.8, and 100%. Given that all levels mentioned above do not exist, we will show you how to turn them on. First, make a double click on the red dashed line on Fibonacci. Then on the same line, right click and choose the first option, Fibo Properties. Click on the Fibo levels. To add the desired level, press Add. In the first field that is automatically selected, enter the correct information of the level. Remember, as the separator, use dot. We will enter a level of 0.786. Click on the side of an empty box to confirm the entry. Then we click on the box description and enter a description of this field. We will follow the existing procedure, which means entry percentage. So we enter 78.6 and click the OK. Now we can see that the new line is inserted, and that is a new level of Fibonacci. We will repeat this procedure to enter a level of 0.886. We do not need this level now because it is not used in regular technical analysis, but as we have said, it is extremely important in the strategy of trading with harmonic patterns. If you want to delete some level, repeat the process of defining the level. Right-click on the previous selected Fibonacci, the red line, Fibo levels, select the level that you want to delete, click Delete, and then click OK. Within this window, there is a lot of useful gadgets. Tab Common provides, for example, the ability to change the color of dashed lines. For example, we will choose it to be green. Type will be dot and dash. See, look has changed. However, we will return the original setting. In the visualization, we can define the Fibonacci at all levels or just some. In this field, it is important to be labeled Show on all time frames, because you want to use Fibonacci in all time frames. You can literally play with those settings and adjust them to suit your needs. At the level of 0.786 Fibonacci retracement, this level is usually related to the harmonic trading, since most traders consider the level of 0.618 as a very significant level and representative of potential turnover. Big players can take advantage and push the price up to the 0.786 level because the most traders place their stop loss here. In this way, the big players push the price against small players, and take money picking up their stop loss orders. This situation is not rare in the market, and it often happens at the time of a publication of important fundamental news. For this reason, in certain situations, it is recommended to wait for this level and then open the position. This Fibonacci level of retracement is also relevant to the specific trading strategy, and it is particularly important for the trading strategy with harmonic patterns in formulating Gartley and Cipher pattern. We will also mention one more level of retracement, and that is 0.886 Fibonacci level of retracement. It is not used during the standard analysis, but it has important application as a trend reversal level at the harmonic trading strategy. It is extremely important for the bad pattern and is considered the most significant level of potential turnover. This will be discussed in the part of the course that deals with the trading strategy with harmonic patterns. Now let's talk about Fibonacci extension. In addition to the Fibonacci retracement, trading involves significant levels related to the extension of individual waves. What does that actually mean? Extension waves are waves that exceed previous bottom when they are in decreasing trend, or waves exceeding the previous top when they are in a growing trend. We turn now to the second graph. We will show you the currency pair British pound US dollar. We observe the return, which is located at the level of 61.8% Fibonacci retracement. As we said, this is the most important level of retracement from which the price started to fall. Now, as you can see, the price has reacted and continued falling trend. The question is how to predict the level to which the price will fall, or the level from which we expect a reversal of decreasing trend. For this purpose, we will use the Fibonacci extension. In previous example, where returns were measured, Fibonacci was trenched in the direction of the trend. When we want to measure extension, Fibonacci stretch in the opposite direction. That means that we extend Fibonacci from the bottom to the top when it comes to falling trend, and from the top to the bottom when it comes to the growing trend. The price fell to exactly 1.618 level. This level represents the golden ratio, and it is exactly 61.8% higher than the previous wave. The price a bit broke through this level and then come to a big turnover. Dealers often use this level as a target or a level at which they close their winning position. In this case, we have seen almost ideal situation for trading with the Fibonacci retracement and extension. We say that because the price was continued initial trend of falling from the most important level of retracement and fell all the way to the most important level of extension 1.618. The levels of return are usually taken as level to enter the position, while extension are mainly used for setting target. Look at the next example. It is a currency pair US dollar 30-minute time frame. By measuring first return, we see that the price has made a reversal at exactly level of 61.8, and from that a moment continues to increase. Now we measure the level of extension. Like previous one, and this example illustrates the power of Fibonacci retracement and extension. Traders who make entry at level of the 0.618 retracement and close their position at the extension of 1.618 have made a huge profit in this case. To repeat, we make entry in position at the level of Fibonacci retracement, while we set the target at the Fibonacci extension of 1.618 and their close position. Although we see that the price has continued to increase and create the opportunity for even greater profit, we advise to stop trading at this level because the price often makes a turnover at this level. In addition to this level of extensions, there are other levels in use like 1.272, 1.382 and 1.414. These levels are also used as resistant, especially in situations where they overlap with, for example, a trend line, channels, previous peak, etc. Also, these levels are of great importance in trading strategies with the harmonic pattern. Now we will show how to enter those levels.
we will enter level of 1.272. Now we see a new line that represents Fibonacci extension of 1.272. Those would be some basics about Fibonacci. This tool is mainly used in combination with other tools of technical analysis. In the next session, we will talk about Elliott waves and Fibonacci influence on their formation. Hi everyone, in this lecture we will do Elliott waves. Before we begin the story of Elliott waves, we will return to one of the first lectures of technical analysis when we talked about trend lines as level of support and resistance. If you remember, we showed one example in the currency pair Euro-US dollar, which was in growing trend. As we see in the graph, the price after breaking the trend line started to grow and then tested our trend line. We said that this level is now a resistance zone from which we can expect a decline in the value of the currency pair, and at this level we had a signal for short. As we can see, the price actually rebounded off our trend line and made a fall of some 160 pips. If you remember, we said that this does not necessarily mean that the price will certainly fall, but with the support of some other tools of technical analysis, this would represent a good zone for short. So let's see if we might be able to find additional confirmation for this short on this currency pair. As we explained, besides trend line and channels, only Fibonacci levels, this time we will use them. We will stretch Fibonacci from top to bottom to see if some of retracement levels matches with trend line. We said that level of 61.8% is the most important level of retracement. We can mark this area. It will represent overlapping area of level of retracement of 0.618 and trend line. We said that we would never take precise point but zone around our levels of resistance. It is this area here. As we can see, the price after deduction of the original trend line started to increase again, entered our zone, reached trend line, almost touched level of 0.618 retracement, and made a huge decline which was more than 300 pips. This combination of different tools is the essence of trading with technical analysis. In this case, that was a combination of trend lines and the most important level of retracement. In this currency pair, there is the third signal for short, and those are divergence on the RSI indicator. But we will explain them in one of the following lectures when we start talking about indicators and oscillators and divergence. Now let's go back to the Elliott waves. The theory of wave movement is based on the Dawes theory, extended by Ralph Nelson Elliott and improved by using the Fibonacci levels of retracement and extension, and created his own theory of wave movement. It is important to say that Fibonacci represents a mathematical foundation for Elliott waves theory. The base on which is built the theory of Elliott waves refers to the movement of price by 5-3 pattern. In particular, the meaning implies that 5 waves form a strong major trend, rising or falling, while 3 waves represent a correction of the major trend. Essentially, this pattern is repeated throughout history, and in combination with Fibonacci levels is one of the most powerful weapons of technical analysis in predicting the price movement. The basis of Elliott waves is a rule that any price movement in one direction causes a return of price in the other direction, which means that any rise or fall in prices triggers a return or correction, while the corrections are only parts of the original trend. The waves in the main trend are always marked with numbers from 1 to 5
while the correction of main trend are marked with letters A, B, and C. The waves 1, 3, and 5 are always in the direction of the main trend, while waves 2 and 4 are correction waves or wave 1 and wave 3. There are some basic rules that should be taken into account if you trade with Elliott waves. The first thing you should know is that it's always trading with the corrective waves 2 and 4 and with B wave in the ABC correction. So it is necessary to wait for correction of the main wave in the trend and then make entry into the position. While the expected tops of wave 3 and 5 are taken as levels to exit the trade, so theirs are targets. The second rule is that the third wave should be the longest wave, while the length of the fifth wave should correspond to approximately the length of the first wave. Another rule applies that is if the second wave is a shallow or if the first wave has a small correction, as shown in this picture, it is considered that the fourth wave will be deeper or the correction of the third wave will be bigger. For example, if the correction of the first wave occurs at the level of 38.2 Fibonacci retracement, then the correction of the third wave is expected at around 61.8% retracement. Wave B should not exceed the top of wave 5. If trading with wave B, you should enter into a position in the middle of the wave A. That means you should wait for the price to be in the zone between 50 and 61.8% retracement of wave A, while the stop loss is placed exactly above the top of wave 5 or the beginning of wave A. In addition, it should be noted that corrective waves 2 and 4 often consist of 3 waves. They are called flat pattern. They are also marked with the letters A, B, and C. We will give a better explanation of those in the following example. The basic two types of flat patterns are running and expanding. The most important difference between these two models is the wave C. If the wave C is lower than the wave A, then it is the expanding flat form. And if the wave C is at higher level than the bottom of wave A, then we are talking about running flat form. These patterns can occur in wave 2nd and wave 4th, although they often occur in wave 4th. Wave B at flat pattern should exceed the top of wave 3, but it is not necessarily. As we see in the first example, the wave B exceeded the top of wave 1, and in the second form, wave B is slightly lower than the wave 3. In any case, both forms are correct and properly labeled. In this case that we work with now, a second wave, as we see, is pretty deep, which means that we can expect fourth wave to be smaller compared to the second as it happened. If we go back to the first example, the second wave was shallow, while the fourth was slightly deeper. In this case, it is the inversely. Another rule is confirmed here, and that is the third wave is the longest, while length of the fifth wave is approximately equal to the length of first wave. As for the flat pattern, so far we have mentioned the basic types, the expanding flat and running flat, pointed out the differences between the two forms and shown how they should be labeled. For your trade, that would be enough knowledge as it concerns flat patterns, but if you want to learn in more detail about these corrections, we will show you all 4 types of these patterns and point out their differences. These include regular flat, expanding flat, running flat, and zigzag correction. Regular flat correction represents the correction where wave B does not exceed the beginning of wave A. Wave B is usually in the zone between 0.382 level of retracement and the start of wave A. When we look in more detailed flat correction, wave A should consist of 3 waves.
Wave B also includes 3 waves, while wave C should consist of 5 waves. Of course, this would be the ideal example, but it should not be taken as a rule because, as we said, the market is not perfect. The following is expanding flat correction, and it was mentioned earlier. In case of expanding flat correction, wave B exceeds the beginning of wave A, while wave C exceeds the beginning of wave B, which is end of wave A. As with regular flat, A wave should consist of 3 waves, as it the case with the wave B, while C represents the deepest wave and should be composed of 5 smaller waves. A running flat, as mentioned earlier, represents correction where wave B exceeds the beginning of wave A, but unlike expanding flat correction, wave C does not exceed the beginning of wave B or the end of the wave A. As in previous two examples, wave A should consist of 3 waves, the same for the wave B, while wave C, which in this case isn't the longest of the 3 corrective waves, still should consist of 5 waves. We repeat that this shouldn't be taken as a strict rule. The last form is zigzag, represents something stronger correction than the previous ones. After this form, wave B must not exceed the beginning of wave A, while wave C always exceed the bottom of wave A. It often happens that the wave A and wave C are almost equal length. Wave A of zigzag correction should consist of 5 smaller waves. Wave B consists of 3 waves, while the wave C consists of 5 small waves, same as wave A. Now we move on the platform and we will do a detailed analysis of the movement of one financial instrument. We will mark all relevant items and indicate potential level of entering and levels of target. We will open movement of Vivendi share. Elliott waves were originally applied on the stock market, but today they are applicable on the other markets such as market of commodities, bonds, futures, CFDs, and especially on the Forex market. The graph clearly shows a growing trend which consists of 5 waves, and its a large correction consists of 3 waves. We will begin with marking. A first wave. This wave is hard to determine because we can never know is it the beginning of the new trend or only correction of the previous. We can see it on the graph when it made a significant bottom. The trade is not recommended with this wave because we cannot predict how much will this wave grow. For this reason, we should wait for the correction of the first wave or wait to form a wave 2 and then make entry into the position. Wave 2. Second wave. This wave occurs when a number of traders, which in this case caused a growth of price and created a wave 1, decide to close their position from fear of changes. This reversal mainly occurs when the price hits the first significant resistance. In our case, at the top of wave 1 and beginning of the wave 2, we have 2 previous significant tops. When we connect these 2 peaks, we will get the trend line and see that the price rebounded exactly from this trend line and formed wave 2. At the wave 2, a zigzag correction can often be formed. We said that this correction consists of 3 waves, of which the first and third are usually the same length. When we measure this, we get the first level of a potential reversal. If this level coincides with some of the key levels of Fibonacci retracement, as we see here that is at almost the same level of 38.2% retracement, we have quite a strong resistance zone and the potential level from which can begin reversal and formation of wave third. Since we have said that trade with wave 1 is not recommended, If you decide to enter into position at a second wave, this would be an ideal moment for a trade. However, since in trading nothing is completely certain, it is always good to put a little more comfortable stop loss, which means that in our case, stop loss should be at least below the 61.8 Fibonacci level of retracement. According to the some rules, third wave should be the longest wave, but in this situation, this is not the case. This situation often occurs within smaller time frames, and particularly in trading with currency pair on Forex. Then it is not a surprise to see that the fifth wave is longer than the third, such as a situation that we have here. Since it is difficult to predict the length of wave 3, it is not recommended to enter the short position and try to capture wave 4 at the earliest stage. As with the first wave, it is necessary to wait for a correction or wait to form the fourth wave and then make entry into the position. Now we'll mark the wave 3 and the wave 4. Wave 4. For this wave, we said that it is usually shorter when the second wave is longer and vice versa. Fourth wave is longer when the second wave is shorter. Since we measured the second wave and it was only at the level of 38.2% retracement, we can expect the fourth wave go up to the 61.8% Fibonacci retracement or even deeper. We will measure this return. We'll stretch Fibonacci from the beginning to the end of the third wave. Now we see that the reversal occurred at the most important level of Fibonacci retracement, 61.8%. In this fourth wave, we see that there was one flat correction. Now we'll mark it. Since the wave B exceeded the beginning of wave A and wave C didn't exceed the beginning of the wave B, this means that this is a running flat correction. If we decide to make the entry into the buy position in the fourth wave, in our case, we should not do that before the price hits a level of 61.8 or at least 50% of Fibonacci retracement, because the second wave has made a short correction at the level of 38.2%. As for a stop loss, it would be the safest place to set it below the level of second wave, something around here. If you're wondering why the stop loss is so huge, it's because we cannot know whether the wave C in this flat correction would be running or expanding, and it is better to ensure with a larger stop loss. When we talk about take profit, it can be defined in two ways. First, you need to measure the wave 1 and based on it to predict the potential length of wave 5. The next thing we do is measure the extension of the third wave. Again, we use Fibonacci and stretch it from the top to the bottom of the third wave. And we will mark the most significant level of 1.618 extension. Zone between these two levels represents a potential reversal zone and you should close your winning position right there. If wave 3 is much longer compared to other waves, the level of 1.618 would be quite high, and in such situation, length of the first wave is taken as a target. Although this market zone looks very tempting to enter the short position, our advice is to never do that, because we said that fifth wave is open the longest and it is impossible to predict when there will be a reversal. Wave A represents a correction of the original trend. As is the case with first, third, and fifth wave, neither with this wave is recommended to trade and you should wait for its correction or wave B. Wave B should consist of 3 waves and should not exceed wave A. Entry into the position should be made when the price exceeds at least half the length of wave A, or we should wait forming of the 3 waves which form the wave B. We will mark that. A third wave should match the length of first wave. Stop loss should be placed above the fifth wave. In this example, we see a very important trend line, which was the line of support until the wave A isn't break it, has become a line of resistance. We can see that around this area the price may turn over, wave B was finished and the wave C begin to form. Traders who choose to trade with wave B and enter the short position in order to catch a wave C, in this case have made a huge profit. As expected target, we can take the length of wave A or 1.618 Fibonacci extension of wave B. This would be all as far as the Elliott waves. It is necessary to say that it is extremely important to correctly mark the waves, even if you do not trade with Elliott waves. This is extremely important because in that wave you will make an insight about where the price is currently located and in which direction it could go. These are the bases which are essential to master if you're serious about trading on the stock exchange. Now it's only necessary for you to open the platform and look for as many waves as possible on currency pair and other financial instruments and marks them on the way we showed you until it becomes a routine. When you have mastered this, everything else should go easier. Hello everyone. In this part of the course, we'll talk about patterns of technical analysis. The patterns or forms of technical analysis often appears on the charts and in all time frames. They can be divided into two criteria, and those are the trend reversal patterns and trend continuation patterns. Regarding trend reversal patterns, we'll explain head and shoulders and double top, double bottom patterns. And as for trend continuation patterns, we'll explain flags, triangles, and rectangles. Let's start with pattern head and shoulders. Head and shoulders is one of the most popular forms of technical analysis and very often may indicate the trend reversal. This form, besides indicating a potential trend reversal, can provide an accurate signal to enter the position with a defined stop loss orders and targets. Patterns head and shoulders in the growing trend provide signal for short, while in the decreasing trend provide signal for buy.
It can be effective on all time frames. It consists of three parts: the left shoulder, head, and right shoulder. These three parts are connected by a trend line that is called the neckline. According to the rules, left and right shoulder should be approximately the same size. In the growing trend, right shoulder should be a little higher and to form a higher peak compared to the left shoulder, while in a decreasing trend, the right shoulder should be located in a lower position than the left shoulder. A very important rule if you trade using head and shoulders pattern is to wait for the pattern to be completely formed. It means that position should not be made until the price breaks the neckline. Many traders do not even enter the position after this point, but wait for the price to make return and test the neckline and then make enter into the position around neckline area. Were you going to make entry into the position immediately after a price breakthrough to the neckline, or wait until the price tests the neckline is completely up to you. Those who are more inclined to risk would prefer to decide immediately to enter the position to achieve higher profit, but there is a high risk because at the market often occur false breakthroughs. What actually happens? Many small traders after a breakthrough enter into short, then the big players, by entering the opposite position, push the price up and take money picking up their stop loss orders. That is what has happened in this displayed case. After the breakthrough of the neckline, more traders have entered into short position and their stop loss orders were placed just above the neckline in reason to earn as much as possible profit with a low risk. But in this situation, they found themselves in a big player's trap who have the power to move price in their direction. If you look carefully, you'll notice one candle that is formed by a large tick and has very small body. It represents previous situation. The price was pushed up for a short period, just enough to close the stop losses of small traders and then return in the right direction. Therefore, our advice is to stay out of the trade after the breakthrough of the neckline and wait until the price comes back, testing the neckline or get close to the neckline zone and then enter into position. As far as the stop loss, it also depends on you, your strategy, and your money management. Our advice is to put the stop loss above the right shoulder in a growing trend and below the right shoulder in a decreasing trend. As for the take profit, it can be lent from the neckline to the top of the head of pattern. Our recommendation is that the stop loss should be moved to a level of entry into the position when the price falls for a high of a shoulder. And then you have trade without a risk. You can't lose anything, and if the price continues to fall, you can earn a lot. This is called trailing stop. Move the stop loss when price moves in the direction that you want to reduce the risk or even ensure a certain profit. Now we'll explain the reverse head and shoulders pattern in a decreasing trend. This shown pattern is on the pair Euro-US dollar on the 60-minute time frame. We see two shoulders that are roughly the same size, and the right shoulder is now a little lower than the left according to the rule. We see that the left shoulder is not really ideal because few candles broke the neckline, but it doesn't matter because you will rarely find the ideal situation on the market. What is important is that the price after the formation of pattern and breakthrough neckline made a return on the same line and give us the ideal situation for entering the buy position. Stop loss is placed under the right shoulder and target is the high of the neckline to the bottom of the head. We see that market with a vertical black line. As you can see, the price has, after entering the position, taken a big jump and achieved our desired target. Although we said that the pattern often indicates a trend reversal, in this situation it did not happen. After achieving target, price has continued with the downtrend. For this reason, we suggest setting targets or take profit orders in the level of the head patterns, or perhaps better to move the stop loss as explained in the previous case. Now we will move on the platform and open pair Euro US dollar in a 4-hour time frame. If we analyze the graph, we'll see a pattern head and shoulders in a downtrend, which means that we have the signal for buy, because this is the reverse head and shoulders pattern. The first thing we notice is that each new bottom is lower than the previous, which means that it is a downtrend. Then we see tree formation that indicate a reverse head and shoulders pattern. We'll connect these tree formation with one trend line and get our pattern. Right shoulder is slightly lower compared to the previous, and both shoulders are about the same size. After the breakthrough of the neckline, price returned, tested the neckline, and then made a huge jump. This is an ideal head and shoulders pattern. To more clearly notice the pattern, we'll mark its elements. Entering into position would be in the area of the neckline. Stop loss below the right shoulder, and the target is a height of the head of the pattern. Unlike the previous case, where the price continued to downtrend after achieved targets, we see that there has been a trend reversal because the price made a significant growth compared to the most important peaks in the graph. Although the price in this case made a much bigger jump compared to our target, our advice is to place take profit at the level of the head height of patterns or use trailing stop to ensure profit, because this ideal situation on the stock market rarely occurs. We'll show you another example to show you that these patterns work on all time frames. It's the movement of Intel shares on the daily chart. We clearly see the pattern head and shoulders in the growing trend. The shoulders are almost the same height, a pattern is formed correctly, and it can be said that it's almost ideal pattern. We can clearly see that the price after breaking the neckline made a return, tested it, and gave us an ideal opportunity to enter the position. Stop loss is set over the right shoulder. The price initially started in the right direction, but it soon broke through the neckline and almost reached the level of stop loss. Even after this, the price wasn't able to close our position. After this, price has made a huge decline and reached the level of the desired target, which represents the height of the pattern. That would be all for the head and shoulders pattern. In the next session, we will explain a double top and double bottom pattern. Double top and double bottom patterns are very similar to the previous form, and if you understood the principles of trading with head and shoulders pattern, this will not be a problem. Double top and double bottom patterns, in addition to indicating a potential trend reversal, as the previous pattern, also provide a signal for precise entry into the position with a clearly defined stop losses and targets. Double top is usually at the top of the growing trend or a particular wave in the growing trend. The shapes of this pattern looks like the letter M and consist of two peaks that are almost the same height. Of course, these does not have to be at identical levels, but it's desirable to be about the same levels. And it is important to mention that the right top should not exceed the left top. The assumption behind this pattern is as follows. In the market, there is always a relationship between bull and bear traders, and when the ratio is on the bull side, or when buying exceeds the sale, it comes to growth of the traded financial instrument. On the graph, this situation appears when we notice a higher peak than the previous. When double top pattern appears on the graph, or when we see that the last peak wasn't exceed the height of the previous peak, traders believe that bull traders lost their power and there will be a trend reversal. Now a growing number of traders take the bearish side and push the price down. It is considered that sales exceeded purchases when price breaks the level of previous bottom. Previous bottom is marked with a red horizontal line, called the neckline as the previous pattern. The break of this line is a signal to sell and our entry into the position. At this level below the neckline, panic orders can be set. We explained them in the first part of the course, so that the platforms automatically activates position when it comes to breaking of the neckline. Of course, this entry should be set up a few pips below the neckline, not directly on it, because it is necessary to wait a clear breakthrough of previous bottom. Stop loss is always placed above some resistance in a dropping trend. In this case, the only relevant resistance are the two previous peaks. So we should set a stop loss a few pips above them. As far as targets are considered, we can determine them in several ways. The minimum profit you can expect is the level of the neckline pattern to the height of the previous peak. This level is indicated by a black vertical line. Since the price can often fall more than this level, you can use a trailing stop by moving your stop loss at the level of entry into the position when the price falls to the level of the first target. Then you have a trade without risk. If the price continues to fall and falls for another length of the target, it is approximately this level here, you then move the stop loss at the level of the first target. In this situation, you ensured a profit and you can continue to move the stop loss according to the movement of the price. Now we can move on the double bottom pattern. Double bottom is in fact a reverse double top pattern. As a rule, should be located at the bottom of a decreasing trend or a particular wave of the decreasing trend. The shapes of this pattern looks like the letter W and has two bottoms which are on almost the same level. In this pattern, it is also not necessary for the bottoms to be at identical levels, but what is important is that the right bottom should not be lower than the left. What can we conclude based on this pattern? Firstly, we can conclude that since it is at the bottom of a trend or a particular wave, we have a situation in which the sale exceeds the purchase of the observed financial instrument. This situation causes a drop in the price of the financial instrument, and on the graph we can see that by noticing that the price constantly forms the lower lows. But the price forms a new bottom on the graph which could not exceed the previous. It is considered that bearish traders lose the strength and there could be a reversal in the price movement. A sign that bearish traders are losing strength is the impossibility to break the previous bottom. A sign that bull traders becoming superior are exceeding the level of the previous peak. A break of this level gives a signal for buy. Enter into a position should be made a few pips above the previous peak. As we said at the double top pattern, it is useful to set the pending orders so we wouldn't miss the entry due to a sharp jump in prices. Stop loss is placed a few pips below the double bottom patterns, while the take profit is set as in a double top pattern, meaning that the minimum target is the length from the previous bottom to the level of the neckline. You can also move the stop loss in case of jump in the price to the level of the first target, and then move again if the price continues to rise, because the price can often make a big reversal after this pattern. Now we'll move on the platform. We'll show the currency pair Australian dollar US dollar on H4 or H1 graph. The first thing we notice on the graph is this drop down wave and then double bottoms, which are at the same level. We'll mark this level. The next thing we see is the previous peak, which indicates the level of the neckline. We'll mark and this level. What did we say? The first entry is made a few pips above the neckline, which means that we would set pending orders or buy at this level here. While stop loss is set a few pips below the previous two bottoms, which is above at this level here. Target is set at the level of the height of the patterns, and it is at about the level of 0.7167. If the price reaches this level, you can close the position or move the stop loss to the level of entering into position, and then you have trade without risk. Then, if the price continues to rise and reaches another target, as it happened, we moved stop loss to the level of the first target. Then we ensured profit, and we're waiting for another growth. Or we can set our target at some level of resistance, for example, a significant peak or something similar, and there close the position. Another example is the currency pair Australian dollar Japanese yen on H1 graph. We see a double top pattern. We'll mark the level where there are two peaks and the neckline. A few pips below the neckline is the right place for entering the position. It is this level here. We see that the price broke through that level, then made a smaller return, and then started in the right direction and made a huge fall. Target is, as we said, pattern's height, or the other option is to move the stop loss and expecting a higher profit. We can notice the double bottom patterns on the graph, which was formed before the double top pattern. We see two bottoms at the same level. We'll draw the neckline, and if you measure the growth after the break of the neckline, we see that the price has reached the level of the first target, which means that almost in the 1 or 2 days of price movement, we have two winning patterns on a single currency pair. After the trend reversal patterns, we'll explain a trend continuation patterns. The trend continuation patterns, as their name says, indicate the continuation of original trend. We will talk about three formations of trend continuation: triangles, rectangles, and flags. As with previous patterns, these patterns also provide signals with defined levels to enter the position, as well as levels of stop loss and take profit. The first patterns that we will talk about are triangles. Triangles are formations that are obtained by connecting at least two tops and two bottoms of the patterns. By connecting these points, we create the formation which has the shape of a triangle. Triangles can be symmetrical, ascending, descending, extended. This formation often occurs in fourth Elliot's waves if we follow the movement of the prices in a trend. Price forms a lower peak than the previous and higher bottom than the previous. The lower line represents the line of support, while the upper line represents the line of resistance.
The price shows a symmetrical triangle. It consists of two symmetrical lines. The space between the two lines represents the space of consolidation. Symmetrical triangle, as well as other types of triangles, has to be defined with at least 4 points. In this case, these are the points 1, 2, 3, and 4. While the price achieved in point 3 must be lower than the price in point 1, and the price achieved in point 4 must be higher than the price achieved in point 2. Two symmetrical lines that overlap indicate that there is a balance between supply and demand in the market, so it can happen a breakthrough on both sides. In the case of bullish symmetrical triangle, it is believed that there will be a breakthrough in the same direction, or break through the resistant line marked with point 1 and 3. In the case of bearish symmetrical triangle, it's likely to happen a breakthrough support line. In this picture is shown bullish symmetrical triangle. After the break through the resistance line, marked with point 5, we have signal for buy. Target profit is the equal distance between points 1 and point 2, while the stop loss is set below the point 4. The following figure also shows a symmetrical triangle in the growing trend. Support line consists of 4 points or 4 bottoms. The third bottom was a bit broke the trend line, but it is not a problem, because as we have said several times, do not search perfections in the market because they rarely occur. Likewise, the two lines that form a triangle may not be ideal symmetrical. It is only important that they form bottoms which are higher than the previous and tops that are lower than the previous. Entering into position is made in the direction of the main trend. It means that you have to wait for a break through the top line of the patterns. It would be even safer if you entering the trade after exceeding the previous peak. Stop loss is set below the E point, that is the previous bottom, while the expected target is height of the patterns that are marked with vertical blue line. We return now to the platform. We'll open the currency pair US dollar Japanese yen on the D1 time frame. In this extremely strong growing trend can be noticed two triangle patterns. The triangles are, in addition to flags and rectangle, patterns of trend continuation, which means that in our case they are providing signals for buy. Now we'll mark the first triangle. We said that the triangles require minimum 4 points. We have the signal to enter the buy position after the break through the top line of the pattern, and stop loss is set under point 4. Target is the height of the patterns, which means the distance between point 1 and point 2, and based on that we can set up our take profit. We can see that the price has reached target level. Now we'll show the second triangle. We'll mark the key points of the patterns. After breaking through the top line of the pattern, we have a signal for buy. We can see that the price has done a little return after the break, tested the trend line, and then continue moving in the direction of the main trend. Stop loss is set under the point 4, and the expected target is the height of the patterns. And this target is reached a little later. As for the ascending and descending triangle, the rules are exactly the same as with the symmetrical triangle. Ascending triangle is in the growing trend. It consists of two lines. Bottom line consists of bottoms of which every following is higher than the previous, while the top lines forms peaks that are approximately at the same level. The break through this line provides a signal for buy, stop loss is set below some of the previous bottoms, and take profit is the height of the pattern. The ascending triangle is in a declining trend. The top line of the pattern is formed of peaks where every next is lower compared to the previous. Bottom line consists of bottoms that are at the same level. The break through this line provides a signal for sell. Stop loss is set above the previous peak and take profit is the height of the pattern. Pattern expanding triangle is a little different than other types of triangles. This pattern is formed by two lines that are extending. Top line of pattern is a line of resistance and consists of at least two peaks where every next is higher than the previous. The bottom line of the pattern is support line and is formed from at least two bottoms of which each following is lower compared to the previous. Entering into trade should be made in the direction of the main trend, but the rules for entering are a little bit different than before. In the declining trend, we enter the position at the top line of the pattern. The expected profit is down to the bottom line of the patterns. Stop loss is set above, for example, a round number, the previous peak, a level of Fibonacci extension from point E to point D, or just above the top line of the pattern. This pattern consists mostly of 5 points, 4 points that form the shape of triangle, while the fifth point is the level of entry into the position. A disadvantage of this pattern is that we have no validation of break through the patterns, such as the case with the previous triangles. This pattern doesn't have a high percentage of success, but the great advantage of this pattern is that when it happens, the profit that is expected is far higher than the risk. The following pattern is a rectangle. Comparing the rules of the patterns, this pattern is the most similar to symmetrical triangle pattern. It consists of two horizontal lines. Top line is the line of resistance and consists at least two peaks at approximately the same level. The bottom line is the support line and is formed from at least two bottoms that are at approximately at the same level. This formation is known as the short sideways trend, which means a period of consolidation. After breakthrough of the pattern lines, usually continues the original trend. By this we mean following. In growing trend, after a period of consolidation, should be continued the growth of price. The opposite, in downtrend, after a period of consolidation, is expected to continue downtrend. This form is easily visible and it can be considered a minor sideways trend. Depending on whether it is located in the uptrend or downtrend, we divide them on bullish and bearish rectangle. The picture shows the formation of the rectangle in a growing trend, so it is a bullish rectangle. Entering the position is made after the break through the top line of the pattern. Price also breaks through the levels of the previous two peaks or points 2 and 4. As shown in the graph, the price is after a break made a small return, tested top line of the pattern and continue the original trend. Stop loss is set below the bottom line of the pattern or below the point 5. Expected target is marked with a vertical red line and represents the height of pattern. The following example is a bearish rectangle. It consists of two tops and two bottoms that are at the same levels. Entering into the position should be made after breakthrough the bottom line of the pattern, while the stop loss is set several pips above the top line of the pattern. This level is indicated by the black line. We can see that the price after breaking through the bottom line of the pattern returned in the pattern borders, but did not reach the level of our stop loss. Then the price continued to move in the desired direction and reached the level of our target, which is the height of pattern. In this case, it is marked with vertical blue line. The flag pattern is one of the most common patterns that indicate the trend continuation. This formation represents a short consolidation of price movements within a sharp growth or fall in price. The flag is considered of support line and resistance line, which may be parallel to each other or overlap, which makes them look like flags. Movement within the flag formation we can mark with waves. Mainly this movement consists of 5 waves: A, B, C, D, and E, after which every following wave breaks through the line of resistance or support and continues the original trend. In any case, the occurrence of 4 points is necessary. 2 of them are lines of resistance and the other 2 form the support line. Flags may be inclined in the direction of the trend, in the opposite direction of the main trend, or simple may be flat. The previous sharp trend forms a flagpole. If the original trend is moving upwards, this formation is called a bullish flag. On the contrary, if the initial trend is moving downwards, such formation is called a bearish flag. In this pattern, we can see great similarity with rectangles and triangles patterns. The difference is that the flags mostly occur in a sharp trend, for example, in time of publications of some fundamental news, which cause a large drop or growth in price. Usually after such a jump, a short consolidation is coming up. This consolidation is caused by closing position by some number of traders. The consolidation is generally short and the price continues to move in the original direction. When we talk about the bullish flag, the entry into the position is made after break through the top line of the pattern. Pending order should be set up several pips above the top line of the patterns because false breakthroughs often happens. That level on the picture is this black horizontal line. Stop loss is placed below the bottom line of the pattern or the lowest point, in this case the point E. Our target is the expected height of the pattern or the flagpole, which is indicated by a red vertical line. Let's move on the platform. We'll open currency pair Euro British Pound. If we look at a drop from October the 13th till November the 4th, we can see that the whole wave is made of flags. From the highest peak until the first significant bottom, which is October the 19th, we have the body of the flag. Then we have the consolidation, which represents the flag. We'll draw a pattern by connecting the upper point patterns. And now we have a line of resistance. And then connect the bottom points of the pattern and we have the support line. Support line consists of 3 points, first, second, and third. The fourth time support line is broken, and in this situation we had signal for sell. After this breakthrough, price has made a huge drop, then that is approximately the height of the flagpole. Then after this fall, followed consolidation has formed another flag. There is also a line of support which is formed by 3 points, 1, 2, and third. The line is broken for the fourth time, and the price again had a great fall. With flags we completed the basic patterns of technical analysis. Almost every day one of the mentioned patterns of technical analysis can be found on the platform. For this reason we will repeat the basic rules that apply to almost all patterns. The first thing that is necessary is to find out in which trend the pattern is and whether it is a pattern that indicates a reversal or continuation of the trend. The second rule, which is very important, is to wait for the pattern to be completely formed, which means that we should not rush getting into position, but should wait for the break through the line of support or resistance, and then make entry into the position. Thirdly, what is important is to respect the rules of stop loss and take profit. Just to mention that trading with these patterns is very gratefully for keeping trading statistics. We keep statistics by creating a table in which we import information about the pattern we have traded, which currency pair, amount of risk, risk-reward ratio, the percentage of success, etc. After a specific period of time, you should have a clear picture of how often certain patterns appears on the graph and what's the balance of trading with these patterns. In this way, you can choose the patterns that work best for you and which give you the best result. And after that, you can create your own trading strategy.
Quantitative or mathematical tools for technical analysis are called technical indicators. They are obtained as a result of mathematical processing of the previous price. They are used to obtain signals for additional estimate the direction of price movement. The main groups of technical indicators are moving averages and oscillators. There is also a division of indicators on the leading and lagging. The difference between these two types of indicators is that the leading are faster than the lagging, and they point to reversal of the price before it happens, while the lagging delayed for a price. Leading indicators in some way provide a forecast of price movements, while lagging indicators provide confirmation of continuation or reversal of a trend. Representatives of leading indicators are oscillators such as RSI and stochastic oscillators, while the moving averages are the most important lagging indicators. In addition to these three indicators, we'll present another indicator and its MACD. The first indicators we'll cover in this course are moving averages. The most simply said moving averages is the average value of the movement of a certain currency for a specific time period. The moving averages has a smoother line in compared to the movement of the price line and provides a clearer picture of the price movements. Moving averages are mainly used as separate indicators, although they are also used to calculate other indicators. The most commonly used moving averages are simple moving averages or arithmetic average, SMA, and the exponential moving averages, EMA. The main difference between these two moving averages is that the first is a simple arithmetic mean, while the exponential moving average is an average of the movement for a specific time interval where are given bigger importance to the latest data. This means that the latest data on price movements affect the most the trend of a moving average, and this indicator is slightly more sensitive than the previous, but it can also give more false signals compared to the simple moving average. In practice, traders usually use a combination of these moving averages as well as the periods to which they are applied. The picture shows three moving intervals, and they are simple moving averages 100, a simple moving average is 20, and exponential moving average 10. SMA 100 indicates the arithmetic average of the last 100 closing price of candles. SMA 20 indicates the arithmetic average of the last 20 closing price of candles, and EMA 10 indicates the weighted moving average of the 10 closing price, where is given greater importance to the latest prices. Of course, for the calculation it can be taken and the opening price and the highest or lowest price for certain interval, which means candles. SMA 100 in the picture is shown as a red line. It is moving average that indicates the direction of the main trend. If it is placed below the price and moving up, it is a growing trend. If it is above the price and moves down, it is a declining trend. SMA 20 is shown with a yellow line, and it provides a clearer picture of the movement of prices. EMA 10 is shown with a blue line, and it is more sensitive compared to the SMA 20, and it follows the direction of the prices the most accurate. Traders on the graph the most attention dedicate to the intersections of the moving averages. In the picture we can see that the price was crossed through the red line or the simple moving average 100, but simple moving average is 20 and the exponential moving average 10 didn't. This situation indicates the false breakthrough, as it happens in this case. Only when the yellow and the blue lines cross through the red line, that is when SMA 20 and EMA 10 broke through the SMA 100, occurred a significant trend reversal. The same situation we have up on the picture, only the price has now made a turn down. First a few candles cross the red line, but in this situation we should not rush immediately to make entry into the position, but wait for the break through this red line by SMA 20 yellow line and EMA 10 blue line. In both situations, the first breakthrough was occurred by the blue line or EMA 10 because it is more sensitive compared to the SMA 20. Breakthrough by the blue line gives us an earlier signals to enter the position and the chance for greater profits, but also frequently gives false breakthrough compared to the SMA 20. Depending on the strategies they use and the risk they are willing to take, traders use different moving averages and define different time periods for the calculation of the moving averages. Now we move on the platform and show how to set them up and determine the time periods for the calculation of moving averages. You need to click on the indicators list button and in the submenu trend select the moving average. Now we have a new window where we can adjust parameters of the moving averages. First, in the period, we have to enter the period for which we want to calculate a moving average indicator. We will enter 100. Then in the MA method section, we have to choose the type of moving average. We will select the simple. In the apply to section, we can choose any price for calculation. We will select close. It means closing price. And in the field style, choose the color and line. We will choose red and slightly thicken the line so we can see it better. Now we will enter the second moving average. We will repeat the process. Just now in the period section we will enter 20 and we will put a different color. We'll choose yellow. We will enter an exponential average. The procedure is the same. We choose 10 as a period, and as a calculation method we choose exponential. We will choose a different color to distinguish the line, therefore is blue. Now on the graph we see a similar situation as we show in the last picture. The first signal for a trend change gives us the candle that breaks the red line. A confirmation of this breakthrough and potential trend reversal are breakthroughs of the blue and yellow lines. Traders that in this situation enter the buy position, they should keep them open as long as the price does break again simple moving average 100 or the red line. This situation occurred here. In this case, traders who enter the buy position in this situation achieve a huge profit. Although this example of trading with moving averages seems very simple and offers great opportunities for profit, it is necessary to point out some negatives of trading with moving averages. First and most important is that they can be used only in trend environment, while in sideways trend would be giving wrong signals. If we look further movement of the graph, we see that the price moving aside. There are many breaking through red lines with candles, which confuses the traders. Another important thing is that moving averages are always late for price and often too late give signals for trade, especially when we await confirmation by SMA 20 and EMA 10. This situation is most common when breaking through the SMA 100 occurs after the publication of some significant fundamental news that causes the huge decline or growth of candles. And the third thing that is important is that the strategy of trading using moving averages makes it difficult to determine the level of stop loss. In our case, as a stop loss, we can take the level below the red line, that is the moving average 100. But as we have said, that often leads to false breakthroughs, and in many situations we would be throughout of the trade with loss, and after that the price would go in the right direction without us, and we would lose potentially large profit. In this case it didn't happen, but it's known to occur, and for this reason we do not trade with moving averages. Relative Strength Index is one of the most commonly used indicator by traders on the stock exchange. This indicator provides information on the overbought or oversold price of certain currency pair. Author of this indicator is Wilder. It was invented in 1978, and according to the author recommendation, the best data is provided if into calculation takes 14 period. In any case, these periods can be set manually on the platform, so traders were adjusting the indicator to their trading strategies. And now are widely used RSI 9 and RSI 25, which means that the calculation has 9 or 25 periods. RSI value is calculated as the average change in price on up divided by the average change in price on down. The resulting number is added 1, then the number 100 divided by the number obtained, and finally all subtracted from the number 100. The value of this oscillator is always between 0 and 100, and the values that traders in particular take into account are 30 and 70. We will now move on to the platform and show how to set and adjust the RSI indicator. Click on the button Indicator List in the submenu Oscillators. choose Relative Strength Index. Now we have a new window where you enter the parameters for adjusting the RSI indicator. The first field is period. We see that is set to the 14 by default. If you would like to change this number, just enter another number. We said that traders besides this period of 14 use the periods of 9 and 25. The difference between the numbers of periods is that the RSI with fewer periods, such as RSI 9, is more sensitive compared to the RSI 14 or RSI 25 and therefore provide more signals for buying and selling. RSI with fewer periods generally use traders who prefer scalping strategy. We will leave a number of 14 periods. In the field Apply To, choose what type of price we use for the calculation. We will choose the closing price. We can choose the color and thickness of line. We will choose the red line and a little thicker in order to better see the line of the indicator. Click the OK button and now we see the RSI indicator on the graph. The first thing we notice is that the space in which the indicator is moving is divided into 3 zones. The first zone is from 0 to 30. The second zone is from 30 to 70, and the third zone is from 70 to 100. The first zone is called the oversold zone, and if the RSI value falls below 30, it tells us that the market has long been in the strong sales zone. The price is too low and that in the near future could be reversal. The second zone, from 30 to 70, is called the neutral zone, and the price generally moves within this zone. It is believed that if the RSI indicator shows a value above 50, and if indicators stay above this level for a longer period, then we should believe in growing trend, while in value of the indicator below 50 indicates on decreasing trend. The third zone is called overbought, and if the RSI index value is above 70, it tells us that in the market a very strong buying zone or that the lately price is in the phase of strong growth and could be reversal or the fall in price. Although at first glance oscillator almost perfectly shows the peaks and the bottoms on the graph, this indicator should not be blindly trusted. First, the RSI oscillator is limited to levels of 0 and 100, while the price has no limits in its movement. Secondly, when RSI enters the zone of overbought, it says that soon could be a price reversal, but it often happens that the indicator remains in the overbought zone for a long time and almost the same level, but price for that time achieve a huge growth. For this reason, we recommend that you never enter the position only on the basis of the RSI indicator, but to use this indicator as a validation of the entry into position or as an addition to your strategy. When you make the entry into the long position, you need to wait for the oscillator to make a breakthrough from oversold zone in the neutral zone. While the signal for entering short position is when the oscillator make a breakthrough from overbought zone in the neutral zone. The most important signal that provides this indicator are divergence. Divergence indicates deviation between price movement and indicator movement. It's obvious that the line which represents indicator movement is very similar to the price movement. But when we have a deviation between price
and indicator movements, we have a significant signal for reversal in the price movement. Also, these deviations are only observed when the indicator is in overbought or oversold zone. Divergence can be bullish and bearish. Bullish divergence is a situation when price on graph makes a lower bottoms compared to the previous, but RSI indicator doesn't show the same. In fact, shows higher bottom compared to the previous. Bullish divergence gives a signal for buy, which means that it can happen turnover from downtrend to uptrend. Bearish divergence is a situation when price on graphs make a higher peak in compared to the previous, but indicator does not show higher peak in his movement. Actually, indicator makes a lower peak compared to the previous. A bearish divergence gives us a signal for short and tells us that can happen turnover from uptrend to downtrend. Although divergence can often provide a good signal for a reversal, as with the indicators, our advice is to use divergence only as a confirmation for entry into the position. Such situation we will show in the currency pair Euro-US dollar. If you remember, on this pair we have already spoken twice and displayed signals for short and said that on that same example we have another confirmation for short and it was the divergence on RSI. Now we will show that. The first signal was strong trend line, which is after the break became the resistance line. Another signal for short was the strongest Fibonacci level of 61.8. These two levels are located in the same area. And the third confirmation for short were divergence. We will now turn on the RSI indicator. As we can see, price made a higher peak compared to the previous on the graph. But the indicator shown a lower peak compared to the previous. It means that we have a bearish divergence and we can expect reversal or a drop in prices as it happened later on. This use of RSI indicator is absolutely reasonable and our advice is to always use this indicator as a confirmation regardless of which strategy you use. This combination of different instrument and indicators of technical analysis is the base for creating your own trading strategy and essential precondition for success in trading. Indicator which is by appearance and characteristics very similar to the RSI is a stochastic oscillator. This indicator is calculated by putting in relation the difference between the maximum price in the previous period and the price of the current day with the maximum price and the minimum price in the previous period. The author of this indicator is George Lane. Usually is used the 21 period for calculating the price range. This indicator, such as the relative strength index, is moving in the intervals between 0 and 100 points. Overbought zone is the zone about 80 points, while the oversold zone is zone below 20 points. When the price is rising or falling, moving of stochastic oscillator is faster in comparison with the movement of RSI indicator. This is the main difference between these two indicators. Another difference compared to the previous indicator is that now on the oscillator graph we see two lines, blue and red. Blue line is called the K line and red D line. Blue line is faster or more sensitive compared to the D line. We have signals for entering the position when oscillator lines from overbought or oversold zone enter into the neutral zone. The signal for buy we have when the blue line cuts the red line from down to up and when both line breaks level of 20. The signal for short we have when the blue line cuts the red line from up to down and when both lines break the level of 80. Of course, as with the previous indicators, our recommendation is not to get into position only on the basis of the indicator, because it can happen that you have a lot of bad signals and therefore losses. But also this oscillator can be good confirmation for safer entry into the position that you have determined based on your strategy. Also important item of this oscillator are divergence and the rules are exactly the same as with the RSI indicator. The price makes the higher peak on the graph. We will see the same example. As oscillator didn't show a higher peak, they shown a lower peak than the previous. And we have a second situation when the price makes a lower bottom on the graph compared to the previous one, while stochastic oscillator didn't show the lower bottom in his movement. Indicator actually show higher bottom in compared to the previous. After this divergence, we can see an enormous jump that amounted over 700 pips. That would be it regarding stochastic indicator. There is nothing special to explain about them because it's pretty much all been said when we explained RSI. Essentially, we don't use both of these indicators in the trade because they will provide pretty much the same signals, and if you are thinking about using this indicator in trade, our recommendation is RSI. It gives less signals for trade, but those signals are more reliable, especially if you're trading strategies based on long-term trading, while perhaps traders who use scalping strategies prefer stochastic oscillator. Anyway, try both of these oscillator, customize it to your strategy and decide which you prefer. The last indicator which we want to explain is the MACD, which means moving average converges divergence. This indicator was developed by Gerald Apple and essentially is based on different simple and exponential weighted moving averages for different time periods. In addition to the stochastic and RSI, and this indicator is very popular among the traders in the stock market. If you look at the picture in our example, we note that the indicator is composed of three components. It's the red line, blue line, and the green histogram. Of course, those colors and components can be modified and they depend on the platform on which is traded. We are now going to say something about these components. In our example, the red line represents the MACD line. MACD line represents the difference between two moving averages. The moving averages that are commonly used in the calculation of the MACD lines are 12 and 26, and we see that numbers in parentheses. The first number, 12, is the faster moving average for 12 periods, as number 26 is the slow moving average for 26 periods. The difference between these two numbers gives the MACD line, and in this example it is this red line. The blue line represents a signal line, and that line is actually exponential moving average 7 in relation to the MACD. A green rectangle represents a histogram, which is obtained as the difference between the MACD line and the signal line. Signals that traders especially pay attention are the intersections of MACD and signal lines. Such situations are marked with 1, 2, and 3 points. When line cuts a signal lines from down to up, we have a signal for buy. When the MACD line cuts a signal line from up to down, we have the signal for short. The histogram provides the information to traders about the power of the trend. According to the rule, when the histogram is growing, it represents strengthening trend. When the histogram becomes smaller, it represents weakening trend. When the price has a growing trend, the histogram has a positive value. When the price has a descending trend, the histogram is negative. We'll now move onto the platform and open the MACD indicator. As you can see, the MACD indicator, which by default goes with MT4 platform, shows only one line, and this is the MACD line, and it shows a histogram. For the reason of showing you indicator that is displayed in the picture and that is used by most traders in the stock market, it is necessary to download the indicator from the internet and import it into the platform. We will now show how to add indicator which is current don't exist in MT4 platform. We will open a web browser and type MACD indicator with two lines. Okay, we can open the first page. It's a website Forex Factory, which can be used for many other useful items such as a variety of information, proposal for trade, the most useful robots, track sentiment of the market, and so on. Here on the forum, we can see a lot of MACD indicator that traders use. We will choose one of them, open the first offered, and save it on our desktop. Now let's go back to the platform, click on the button File, and on the drop-down menu select Open Data folder. Then you need to open the folder MQL4, and after that open the folder Indicators. The only thing that is still needed is the MACD indicator moved into the folder Indicators. Now we are going to switch off and start again our platform. Select any pair, click on the indicator list, and in custom menu select our new MACD indicator which is inserted, and then click the OK. Now we see two lines and histogram. Information about the period are 12, 26 and 9 as well as in the previous example. And these are also the most common components used by traders in the stock market. If you want to change parameters, you must open MACD properties and in tab inputs enter the data you want. The difference in this indicator compared to the indicator explained in the previous illustration is only in color.
In this indicator, MACD line is shown as a blue line and the signal line is shown as red line. Of course, this can be changed, but it really doesn't matter. All that matters is that the components and rules are the same. As we said, you have to follow the intersection of the MACD and signal line because it shows the potential reversal in the direction of the price movement. In addition to intersection of these two lines, we have a potential signal for reversal of the trend when divergence appear. That is the situation when the price on the graph show a lower bottom compared to the previous and the indicator shows a higher bottom from the previous. In this situation, the indicator shows a change in trend from downtrend to uptrend. The second situation is when the price on graph show a higher peak in comparison to the previous, but indicator shows a lower peak compared to the previous one. So the indicator points to a reversal of the trend from uptrend to downtrend. Such situation we have in this example where after divergence there was a decrease in the price for over 260 pips. As with the previous indicator, we will also point out some shortcomings. The biggest disadvantage of this indicator is that it is formed based on the moving average. We know that moving averages are late compared to the price, and that delay on MACD is more visible because it is based on the an average movement of other average movements. Besides, this MACD indicator is very used by stock traders and it is our recommendation to use it freely, but only an addition to your strategy, not as the only tool that you will use in trading. This would be a recommendation for any indicator used in trading. Of course, for each of these indicators and oscillators could be made a separate course, but because we rarely use them in our strategy or use them only as a confirmation, we didn't want to get into details. We will leave that to the traders who use them mainly in scalping strategies as the only tool in their trading. Fundamental analysis is an important tool in determining the overall direction of the movement of exchange rates. Its importance is critical to the long-term strategies of trading. Participants in the foreign exchange market, which trade is based on fundamental analysis, at the same time perform an evaluation of economic indicators, political environment, as well as other macroeconomic factors. These factors are related to the countries whose currencies are traded and also on the countries that have a significant impact on the entire financial market, such as, for example, countries which are big manufacturers and exporters of oil, gold, and other commodities. The factors of fundamental analysis can be divided into factors that can predict and unpredictable factors. Unpredictable factors are factors which have a fast and great impact on the movement of the currency pairs. In these factors, we can cite political situation, military events, terrorist attacks, natural disasters such as earthquakes, floods, fires, tsunami, and others. Factors that cannot be predicted are characterized by the inability to define the time of their occurrence and also a degree of influence of these factors. An example of the influence of unpredictable factors is the tsunami that hit Japan in 2011 year and caused extremely large human and material damage. The price of Japanese yen made large increase compared to the US dollar in the next few days. Reason for the increase of Japanese yen was in the fact that the insurance company started to buy yen to do the reimbursement caused by damage, which led to the disruption of the movement of the Japanese currency. Predictable factors include information that is published regularly during the day and which schedule is known in advance. This group of news includes information such as the statement on monetary policy, information about interest rate, data related to inflation, the unemployment, etc. The most powerful influence of predictable factors on the market has a monetary police that central banks carry out in order to regulate economic activities. Monetary policy is a set of measures and activities that state authorities are taking in order to regulate the money supply. It binds to itself the financial policy because the implementation of monetary policy requires a strong and regulated financial system. The goal of each monetary policy are achieving certain economic effects. There are two groups of objectives, and those are development goals and stabilization goals. Development goals include specific measures and techniques in order to develop the economy. When the country carries out these measures, we can say that it leads the expansive monetary policy. Stabilization goals, they are based on measurements and instruments that are applied in order to stabilize the economy. When the governments are implementing these measures, we say that it leads a restrictive monetary policy. Implementation of expansive monetary policy is found in economic systems that have a tendency to decline, or in those economies where, for example, there is rising unemployment, decrease in gross domestic product, the recession, etc. In such situations, the aim of the government and the central bank is boosting the economy and coming out from the recession. Those results are usually achieved with the cutting off the main interest rate by increasing the volume of loans to the economy and the population and reducing the rate of required bank reserves. Restrictive monetary policy is characterized by limiting the demand for money and bank loans by monetary authorities. A restrictive policy is the policy of expensive money and difficult credit conditions. This applies in a situation where the demand is bigger than the supply, where there is a risk of price increases, which means a rise of inflation. The most common instruments are increase of the main interest rate, increased rate of required reserves, and restriction of credit for economy. There are a variety of these instruments that are used to achieve defined objectives, so we're going to count those who are most commonly applied. The discount policy is the policy that defines the level of interest rates. As a direct result of this policy comes to increase or decrease in demand for the currency, which directly affects the growth or decline in value of that currency. Operations on open market include the purchase and sale of currencies by the national bank. Reserve policy, implementation of this policy directly affects the credit potential of the banks. And credit and deposit policy. National banks of different countries have different goals. Different goals applies different macroeconomic measures that governments are undertaking in order to stabilize the economy. For example, the basic objective of the European National Bank is price stability within the limits of around 2% of inflation. When it comes to the United States of America, as the first and the strongest economy in the world, the objectives of the Fed as a National Bank of America are keeping a high unemployment rate. The National Bank of Japan seeks to achieve low inflation rates. The economy of Japan is marked with the deflation factors, which reduce the value of domestic currency. By understanding the monetary policy, we acquire insights about the long-term direction of movement of a certain currency. As for the currencies in Forex market are paired, of course, it's not enough to look at the monetary policy only of the base currency in pair, but we have to follow the monetary policy of both currencies. For example, if we want to get into a long-term position in the currency pair Euro-US dollar, we'd have to study what kind of monetary policy leads the European Union and United States. In recent years, the European Union has carried out expansion policy because it was in big recession in order to improve economic activity. The European Union wants to achieve these goals by cutting off the base interest rate, which is causing a decline in value of the euro. A cheaper euro causes the lower price of the goods exported from the European Union, and the result of these measures are increasing competitiveness of product from Europe. At the same time, the US is in economic expansion. The National Bank of United States was reducing the purchase of bonds in the market from month to month until it was abolished. Unemployment has been reduced to a level below 6%, so the Fed has even raised its base interest rate. These indicators clearly indicate that the European Union economy is in decline, while the US economy is in expansion. All these have reflection on the stock market, and the euro fell compared to the dollar by 20% in 2014 when they started with aggressive expansion politics. Indicators of fundamental analysis that most traders follow on the stock market and which have a significant impact on the movement of currency pair are movement of gross domestic product, interest rates, inflation, data on employment, trade balance, indicators of retail, information about real estate, indicators of industrial production. Gross domestic product is the sum of goods and services produced by domestic and foreign companies in the country. There is a real and nominal gross domestic product, and as a more precise indicator is used real gross domestic product. This is a very important indicator for traders in the stock market. Of course, growth of gross domestic product affects the strengthening of the domestic currency, while the decline in gross domestic product affects the weakening of the domestic currency. Interest rates are one of the most important factors that determine the value of currencies in the foreign exchange market. Since the currencies in the market are in pairs, it is necessary to follow the interest rates that apply in countries for both currency pair. This relationship between the interest rates is called the interest rate differential. Information about interest rates have a large impact on the currency movements. For example, if there are certain indication that interest rates will decrease, a certain currency will be sold before the information is published. The biggest changes in the value of currencies are caused by unexpected and unannounced changes in the interest rates. General rule that traders use is that tendency of weakening during a long period of time have currencies with lower interest rates, while the tendency to strengthening during a long period of time have currencies with higher interest rates. As for the interest rates, they tend to grow over the economic cycle of expansion and tend to fall during economic recession cycle. Indicators of inflation also have a huge influence of currency exchange rates because they have an impact on the reduction of or growth of interest rates in the country. Every country has measures to manage inflation, and this sort of activities is closely monitored by traders. To track inflation and on that basis make conclusions about whether the national bank might take measures to regulate inflation, for example, rising or reducing interest rates, traders use the following data: index of industrial prices and consumer price index. Index of industrial production prices, it comprises of information from economy sectors such as manufacturing, mining and agriculture. It includes foods, products, energy, fuel, machines, equipment, vehicles, etc. This index does not include imported goods, services, and taxes. Consumer Price Index is the average price changes on the market basket. Consumer Price Index data consists of the samples on the price of food, shelter, clothing, fuel, transport, and healthcare. The index is considered a base inflation indicator, and the data for this index are collected from 19,000 retail stores and 57,000 households, while the structure of the market basket is 44% of goods and 56% of services. Employment data are important economic indicators that represents the strength of each country's economy. This indicator tells us about the number of new open and closed work positions, as well as the percentage of the activity workforce. Standard indicators that traders are interested in are unemployment, industrial payroll, payroll in a non-agricultural sector, the average salary, and the average work week. In general, the most significant data on employment, especially when it comes to the United States economy, are payrolls in the industrial and the non-agricultural sectors, and the second is unemployment rate. Trade balance represents the difference between the imported and exported services and products. It is important to point out that traders should focus on the 3-month seasonal custom revenues because the month-long are considered as unreliable. Countries that export more than they import are in a positive trade balance, which for result have strengthening in currency. Countries that imported more than it exported is in negative trade balance, which leads to a weakening of the currency. These parameters have a significant influence on the value of the currency because a positive or negative trade balance shows the competitiveness of the domestic economy in compared to the foreign country. Retail is one of the most important indicators of consumption for traders in the foreign exchange market. This indicator shows the strength of consumers' demand as well as changes in the volume of retail sales. It is available on the monthly basis, but because of frequent fluctuation and the seasonal character, makes more sense to observe on a quarterly basis. Retailing is an important economic indicator for United States of America because the focus of United States economy is consumer. If a consumer has a sufficient wage, he will be able to spend more and thus comes to greater demand for products and goods which result in an increase in production. For traders, this is an important indicator because consumption in retail measures strength of the economy and therefore the strength of the currency. Information about real estate provide a sense of optimism of consumers and of their ability to buy more expensive goods. These data are strongly connected with interest rates because they affect the height of the loan interest. Lower interest rates on mortgage loans leads to greater demand for those loans and thus comes to greater demand for real estate. This sector of the economy is very important for every country because it affects the development of other sectors such as the construction of roads, then starts the production of furniture and all the other things that are necessary for equipping of living space. The higher the value of this indicator marks a healthy development of the economy, so the increase of his value has a positive impact on the national currency. Industrial production indicators consist of the total products of national factories, mines, utilities, and so on. It is published every 15th of the month. The data are for the previous month. This indicator is related to the gross domestic product, so that has a major impact on the value of exchange rates. In the United States, 40% of the total economy is off to the industry, which means that has significant impact on the GDP and the value of the US dollar. All these economic indicators that we have mentioned in previous lecture, traders follow view economic calendar. The economic calendar provides an overview of all the important news in the field of economy and finance, or news and events that traders use to make a decision about trading. Economic calendar is the essential part of fundamental analysis that every trader on Forex market should apply on short-term as well as long-term trade. In the economic calendar, we have a display of the daily news sorted chronologically by the time of their publication. On the economic calendar, which can be found on various internet sites, you have the option to setting the time zone in order to customize the news in adequate term for a trader depending on the country where the trader is located. We will now move to the website through which we are looking for news for the economic calendar, and its website investing.com. On this site, in addition to the economic calendar, you can keep track of all the other news in the domain of economics, politics, as well as news related to the indices, commodities market, shares, etc. In order to open the economic calendar, in the upper menu, choose economic calendar and then select the time zone that corresponds to your country. By clicking a filter, you can choose which country's data you want to see in the economic calendar. Of course, by default are already selected countries whose currency are most commonly traded. Also, you have the option to choose whether you want to publish only the most important information or all, regardless of their impact on price movements. The economic calendar provides three types of information when it comes to news that are published. The first group of information shows the previous information regarding some data, and they are located in this column here. Another group of information is expected data. These forecasts are imported by experts in the field of economic and finance. These data are located in the middle column, and the third group information is newly published news or the current information, which are the most important. Depending on the differences between the previous and new data, as well as between the new and expected data, we came to the conclusions about the possible direction of movement of prices. As for the importance of the data that are published, all news in the economic calendar are divided into three groups. These are so-called one bull news, two bulls news, and three bulls news. One bull news can affect the movement of prices, but their influence is not too big, which means that it should have happened a couple of news for the same currency, and this news should be significantly different from previous and expected, so they would have some impact on the movement of prices. But also in such situation, that impact is mostly small and short term. Two bulls news can have a large effect on the movement of prices of currencies. The situation when in the same period of time appear more such news, and when the news are drastically different compared to the previous and expected, they may have a great impact on the movement of prices. Also, two bulls news like one bull news have a short-term impact on the movement of currency pair. Three bulls news are news that can have a tremendous impact on the movement of prices of currencies. This is the news we've previously explained, and it is news regarding GDP, employment, interest rates, inflation, etc. If this news on the time of publications are quite different from previous or expected, they almost always have a result in a powerful movement on the market. In such situation, it can happen that price break through all resistance and support levels identified by technical analysis. For this reason, it is recommended for small traders not to make entry into the market in time of publications of this news, but wait for the market to calm after the published data and then make decision on trade. In addition to economic calendars, of extreme importance is the following of important international events on political, economic, financial and military scene. These news are extremely important that may, in addition to the information provided by economic calendar, have great effect on the currency price movement. A successful trader must follow all of the above information and events. When it comes to news that are also important for the fundamental analysis, we recommend some of the following websites: Bloomberg, Dukascopy, Reuters, Investing, Forex Factors, and MarketWatch. Sentiment analysis is quite different compared to the technical and fundamental analysis. It is specific because it cannot just learn from some examples or books, but as the meaning of this analysis says, it's feeling about the possible direction of movement of prices, and that feeling is gained through many years of trading on the stock market. Each trader has their own personal attitude about why the market is moving in a particular direction. When trading, they use their knowledge, experience, and emotions and make decisions based on them. However, no matter how the trader is confident in his trading ability, the market is moving in a particular direction and the traders can always end up with a loss. For this reason, every trader must realize that the movement in the market is caused by the combination of ideas, attitudes, opinions, and emotions of all participants in the market. It can be said that market is driven by fear and greed. The fear of losing money and greed for increasing profits. Every trader who once tried to trade on the stock exchange must have encountered with these two feelings. The combination of ideas, attitudes, opinions, and emotions, fears, and greed of all individual traders is what we call market sentiment. The task of every trader is to estimate what the market feels at some point. Market sentiment is not used to accurately determine whether to enter or exit from a position, but provides us with the assumption: are there currently in force bullish or bearish traders, or which of groups we should join or even do not trade. Of course, it should be underlined that sentiment analysis should always be combined with fundamental and technical analysis. Based on the widely used of basic forms of technical analysis and clear data from fundamental analysis, we can conclude how might respond the total mass of traders on the stock market. Sentiment analysis explain why certain information that come to market does not reflect at the same time and in the same way. In one situation, after the publications of some important economic news, we can notice a huge price reaction. As in the following month, the same information does not have to have any impact on the price. This is contributed by the size of the market, a large number of participants of different beliefs regarding the direction of movement of prices, and etc. What does this tell us? It tells us that some fundamental news or some known form of technical analysis will not by itself cause growing or declining in values of financial instrument, but it's caused by reaction of traders on that news or pattern. So no matter what particular news from fundamental we see as very important or we notice the specific technical form,
If the majority of traders in the stock market didn't recognize that news as important or didn't found technical pattern, the markets will stay in the same or even maybe price will go in the opposite direction of our perception of the situation. So with sentiment analysis, we came up with an answer why the market is moving in the particular direction, although the fundamental and technical analysis said otherwise. Just because the sentiment analysis is based on emotion and fear, it can often give us an answer about the direction of movement of prices that goes against our thinking. The combination of fundamental and technical analysis provides a basis for developing sentiment. Using fundamental and technical analysis, we get basic access to the situation on the market, in what direction the market may move, what is the psychology of the masses, or what is the sentiment of the market. For this reason, advice for traders is the following. First, learn all there is about the fundamental and technical analysis. Try to apply this analysis in your daily trading and follow the market reaction to the published news and specific technical forms. Over time, you will stop the rush to any situation on the market. You will be able to accept losses more realistic and more calm, which will eventually be lesser and lesser, and slowly you will be forming market sentiment that will become an important tool in your trading.
Hello everyone, in this part of the course we will deal with the harmonic trading strategy which we successfully use on the stock exchange for several years. First we will say something in general about all harmonic patterns, and later we will explain in detail the patterns that we use in our strategy, and in the end we will show the live trading on the real account. The beginning of the harmonic mode of trading is linked to the Harold Gartley. In 1935, he defined and represented his trading method in the book Profits in the Stock Market. This book, in which he defined the look and significant points of his pattern, was a sensation among global traders. The popularity of this book was confirmed by the fact that it was very sold despite the price of a book that was worth almost as 3 new Ford cars. A pattern that has been formed by Harold Gartley is the first in the system of harmonic patterns and naturally was named by its author the Gartley pattern. In addition to the Gartley pattern, next significant discovery represents butterfly pattern that was discovered by Larry Pasavento and Bruce Gilmer. When we talk about harmonic patterns, we cannot forget to mention Scott Carney. He is one of the most important people when it comes to harmonic trading. In 2010, he published 2 books in which he published 2 new patterns, the crab and the bat pattern. Besides these 2 new patterns, Scott Carney has worked on improving the existing patterns. In addition to these 4 patterns, there are 2 other important patterns, and these are shark pattern and perhaps the most important pattern, at least in our experience, it's the Cyper pattern. First and foremost, we have to say before we get into any kind of analysis that for this way of trading, Fibonacci is the most important tool, and if you are unfamiliar with Fibonacci, go back to our second module and repeat lessons about Fibo extension and Fibo retracement. As long as you do not learn well Fibonacci, you cannot start with the harmonic trading strategy. Now we'll briefly say a few words about each of these patterns, and then we will move on to a detailed analysis of only those patterns that we use in our strategy. The first is Gartley pattern. In addition to the original version from 1935, there are many authors who have given their interpretation and understanding regarding trading using Gartley pattern. One of the most important authors is Ross Beck, who has improved this pattern by pointing out the risk reduction in trade with Gartley pattern. There are 4 waves that form the structure of the Gartley pattern. 4-wave principle characterizes also all other patterns of harmonic trading, and we will now show how to correctly mark the main waves and points of Gartley pattern. The pattern consists of 5 points: X, A, B, C, and D. The waves are labeled with points XA, the first wave, AB, the second wave, represents the correction of the first wave, BC, it can be a retracement or an extension wave. In the case of Gartley pattern, it is always retracement wave, which means that it must not exceed the level of point A. And CD, the last wave. After forming this wave, an entry into the position should be made. The most important condition that must be respected in determining the Gartley pattern is to define the level of the first retracement. This retracement is critical in defining Gartley pattern. So point B must be at the level of 0.618 Fibonacci retracement of the wave XA. A wave BC should be at least 50% Fibo retracement of wave AB, but it is important not to exceed the level of point A. The last wave is expected at the level of 0.786 Fibonacci retracement of wave XA, and on that level we make entry into the position. Butterfly pattern is the second pattern in harmonic trading. According to the Passavento, the first level of retracement that is used as confirmation of the butterfly pattern is the level of 0.786, a Fibonacci retracement of wave XA. Unlike the Gartley pattern, point D in butterfly pattern exceeds the start points of pattern and is measured with Fibonacci extension. Expected level of entry into position with butterfly pattern is the level of 1.272 Fibonacci extension of wave XA. The picture shows a bearish butterfly pattern formation. We see that the retracement was at the level of 0.764. This level is almost the same level as 0.786, and the difference is only in the different platforms or Fibo properties. Potential reversal zone is the most accurate determined by Scott Carney. According to him, this zone is determined by 3 levels. The first level refers to the most important point of reversal, or at the level of 1.272 Fibonacci extension of wave XA. That level would be obtained if we stretch Fibonacci from point X to point A. For the second level, we take the 2.0 Fibo extension of the BC wave. That level would be obtained if we stretch the Fibonacci from point B to point C and mark 2.0 level of Fibo extension. The third point represents Fibonacci extension of wave AB. We stretch the Fibonacci from point B to point A and mark 1.618 level of Fibo extension. To determine the potential reversal zone, the author primarily used extensions of wave XA and BC. Looking at the Fibonacci extension of XA and BC waves, we see that are at the same level. This means that this zone represents a good opportunity to reversal that occurred very quickly after the price broke through the level of entry into the position. In our trading, we do not use this pattern because many traders have the theory that it's better to wait for the entry into the position level of 1.618 instead of 1.272. We had a lot of bad trades with this pattern, so we decided not to use it in our strategy. bat pattern. This pattern very often appears on the market. It was discovered by Scott Carney in 2001. The pattern is specific by adding a new level of Fibonacci retracement as a level of entry into position. It is the Fibonacci retracement of 0.886. According to the author, bat pattern structure should be defined as follows. First retracement, or point B, must be between 0.382 and 0.50 Fibonacci retracement. Point C should be at least 0.382 and a maximum 0.886 retracement of wave AB. Ideal retracement of the second wave, or point C, would be 50% Fibonacci retracement of wave AB. The strongest level within the zone of potential reversal is the level of 0.886 Fibonacci retracement of wave XA. So stretch the Fibo tool from point X to point A, mark the level of 0.886, and at that level make entry into the position. This pattern often occurs in our trading, and we will explain in more detail a little later. Crab pattern may be ordinary and deep crab pattern. Like all pattern, it consists of 4 waves, and its features are as follows. Correction of wave XA must be within the range of 0.382 to 0.618 Fibonacci retracement, which is pretty unclear information. As you can see, a Gartley pattern has a first retracement on a 0.618, and BAT has first retracement between 0.382 and 0.50, which means that the crab pattern can be easily mixed with these two patterns. Expected point of entry into the position represents a level of 1.618 Fibonacci extension of wave XA, so it represents the longest extension between patterns. Correction of wave BC must be included the interval between 0.382 to 0.886 Fibonacci retracement of the wave AB, which is exactly the same as with the BAT and Gartley pattern. As a potential reversal zone, in addition to the level of 1.618, the extension between 2.618 and 3.618 of the waves BC is also taken. When these two zones found at approximately the same level, we can say that we have a strong zone for a potential reversal. On the shown example, retracement of the wave XA was at 0.618, retracement of the wave AB was at the same level also, and potential turning point zone is marked by a level of 1.618 Fibonacci extension of wave XA and the level of 3.618 Fibonacci extension of the third wave, which is BC wave. Regarding the deep crab pattern, only difference compared to the ordinary crab pattern is in the first retracement or the point B. The first retracement in ordinary crab pattern includes the interval from 0.382 to 0.618 Fibonacci retracement, while the first retracement on deep crab pattern is defined at 0.886 Fibonacci retracement. A deep crab advantage compared to the crab pattern is that you cannot mix it with other patterns. Because the crab pattern is easily mixed with other patterns before the fourth wave occurs, and because it is necessary to wait a long time to form these patterns, this pattern is not in use in our strategy. Bad sides of this pattern are also that often extensions of wave XA and wave BC does not coincide at the same level, so it is difficult to determine the level of stop loss. Shark pattern is one of the newest patterns in harmonic trading. On the contrary to other patterns that we have explained, this pattern has an extensive wave BC, which means that this point C exceeds the level of point A. The critical levels of the patterns are as follows. Correction of wave XA or point B should be at the level between 0.382 and 0.618. Wave BC is extensive and its extension should be between the Fibo extensions of 1.13 to 1.272 of XA wave. Point D, or the level of entering into the position, is the 1.13 Fibo extension of XA wave. This pattern does not appear so often on the stock market, but when it does, it may bring several times more profits compared to the risk, and this is the reason why we use this pattern in our strategy. The last pattern that we will present is the cipher pattern, also a pattern that was recently discovered. Very often it appears in the graph. Next to the this pattern is the most common pattern in our trading experience. Like all other patterns, it is marked with 5 important points, X, A, B, C, and D. The first correction is point B. It's expected at the level between 0.382 and 0.618 of the XA wave. This pattern, like shark pattern, has extension wave BC, but with the cipher patterns this extension is slightly longer and is between 1.272 and 1.414 Fibo extension of wave XA. Level of entering into the position is the level of 0.786 Fibo retracement of wave XA. This pattern is very present in our trading, and there will be more about this later in the course. Of all the harmonic patterns that we have briefly explained, in our trading strategy we use 4 of them, and those are Gartley, Bat, Shark, and Cipher. Reason for not using other trading harmonic patterns is that they are easy to mix with other patterns and long waiting to entry into the position. These were some of the basic features that apply to harmonic patterns. In the following lecture we will explain in detail only these 4 patterns that we use in our strategy, show the exact levels to enter the position, our defined levels of stop loss, and expected take profits. Now we will show drawings with defined all major points and levels which are important for a determination of patterns, entry level in the positions, and defining the levels of risk and expected profits. All these drawings show the rules of our trading strategy. In addition to this video, you will receive material in the format of images, and you can use them as a reminder during your trade if you decide to try trading strategy with harmonic patterns, of course. Now let's move on to the first image. We will explain the rules for trading with bullish Gartley pattern. First thing we note are these higher peaks which are formed. These higher peaks indicate a growing trend. This means that we make trade in the trend direction. So when the bullish Gartley pattern that gives a signal for buy finds in a growing trend, we are entering into buy position. If the bullish Gartley pattern, such as shown in the picture, found in a downtrend, we will skip that trade. So the first rule is trading in direction with the trend. In the growing trend, we make entry into buy position. In the downtrend, we make entry into sell position. As a trend, we do not have to enter the position only in very strong trends. It is enough to appear some higher peaks that represent some short-term trend or the correction of the main trend. Of course, the chances of success are greater if the pattern is formed in a strong trend. How do we notice bullish Gartley pattern? Just visually, as well as any other pattern. The pattern consists of 4 waves. After the formation of the third wave, we can expect that it will form some of the harmonic patterns. If the point C does not exceed the level of point A, we know that it is or Gartley or the bat pattern. If it exceeds the level of point A, it can be formed shark or cyper pattern. In order to clearly determine the pattern, we use the Fibonacci tool and measure the retracement and extension, and on the basis of these measures we defined patterns: the level of entering into position, stop loss, and take profits. The most critical point of Gartley pattern is the first return, point B. This retracement should be happen exactly at the level of 61.8 Fibo retracement of wave XA. No big deal if there is a deviation of few pips, but should not be more. Another important point for defining the Gartley pattern is point C, which has a range of movement between 38.2 and 88.6 Fibo retracement from wave AB. The most ideal retracement is at the level of 61.8%. Point D represents the level of entry into position. It can be determined in two ways. The first way is to simply measure the Fibo retracement of 78.6 of the wave XA, mark that level, and on that level make entry into the position. Another way is to measure a length of wave AB and replace it with wave CD. The end of wave CD, or point D, is level of entering into position. When the wave BC is slightly longer, in this situation this level will coincide with a level of 78.6, and when a wave BC is shorter, the level of entering into position will be slightly below the level of 78.6. After determining the level of entering into position, the next thing we do is determine the level of stop loss. Stop loss when it comes to Gartley pattern is set at the level of 1.13 Fibo extension of wave XA. So it is slightly below the point X. As for the take profit, always stand it to be at least 2 times higher than the risk. So if the stop loss is 30 pips, we set take profit at a minimum 60 pips. But take profit is not fixed, and we move it if price goes in the desired direction. So we use trailing stop. How we do it? Like this. If our stop loss is at 30 pips, we set take profit at 60 pips. If the price moves in our direction and rises for 30 pips, then we will move the stop loss at 0 level and we will have trade without risk. If the price continues to rise and reaches the level of 60 pips, we have two options. The first is that at this level we close the trade. We do it if we find some important resistance at this level or if our fundamental is not on our side. Another option is if we believe that the price will continue to rise, we simply move the take profit for 30 pips up and move the stop loss to plus 30 pips. In that way, we ensure 30 pips profit and we expect 19 pips. And we just continue with the movement until we find any significant resistance or the price itself returns and close our position with a certain profit. As for the risk per trade, we always use 1% of the total account, and this applies to each pattern. What level of risk you will use depends on you, but our recommendation is to not risk more than 3% if you plan to use this trading strategy. Another important thing in our strategy are pending orders. We have explained them in the basic module, so we will not repeat them now. Let's just say that we never wait that the price falls to a level of point D, but before forming of point D, we set pending order with stop loss and take profits and let the market do the rest. If the price reaches the level of entering into position, the platform will automatically open a trade. If the price does not reach our level and continue in the opposite direction, the position will not be activated and later we can cancel the pending order. After the bullish Gartley, now we will explain bearish Gartley pattern. Concerning trade rules, they are the same as the bullish Gartley pattern, except that now the situation is reversed. The lower bottoms on the side indicate that this pattern is only played in a downtrend, while the bearish Gartley pattern would be skipped in the growing trend. This pattern provides a signal for short. It is marked with 5 essential points, of which is the most critical point B. The return is expected at almost exactly 61.8 Fibo retracement of wave XA. Wave BC has a range of movement from 38.2 to 88.6 Fibo retracement of AB wave, and the entry into position is made at the point D, which is located at the 78.6 Fibo retracement of wave XA. In this particular case, it would mean that we would set a sell limit order at the level of 78.6 before the price came here and waited for the price to hit the required level and activates the position. As we said, stop loss we set at 1.13 Fibo extension of wave XA, and we move take profit with movements of price or set it at minimum 2 times bigger level compared to the stop loss. This would be all as far as the basic rules for trading with the Gartley pattern according to our strategy. Now we move on to the next drawings and explain in detail the trade rules with the following patterns that we use in our trading, and this is the bat pattern. At the first glance, the bat pattern looks like very similar to the Gartley pattern, but the points that define bat pattern are found at the other levels. The first rule is the same for all the patterns. It refers to trade in direction with the main trend. This would mean that we would enter into buy position only when we find bullish bat pattern in the growing trend. The main difference compared to Gartley pattern is at point B and the point D. Point B in this case is not defined accurately with a certain level of Fibonacci, but for determining point B, it is necessary to take the range between 38.2 and 50% of Fibo retracement of wave XA. This retracement must not exceed Fibo level of 50% and cannot be less than 38.2% of Fibo retracement. Regarding the point C, it's defined the same as in the Gartley pattern, which means that it should be located between 38.2 and 88.6 Fibo retracement of wave AB. And point D is located at a lower level compared to the previous pattern. Entering the position is now made at the 88.6% Fibo retracement of wave XA. Stop loss is set at the level of 1.13 Fibo extension of wave XA, while the take profit can be adjusted if price moves in the desired direction, or it can be fixed at a minimum double level compared to the stop loss. Although this pattern was developed from Gartley pattern, it's much more grateful for trading compared to Gartley. Why is it so? For the simple reason that the entry into the position is made at a lower level. From the level 88.6 has less pips to the stop loss than the level of 78.6, which is relevant to the Gartley pattern. This means that we have minimized our risk for the number of pips between the levels of 78.6 and 88.6. Take profit remains unchanged, which means that for a smaller risk we achieve the same profit, or for the same risk we achieve higher profits using that pattern. Just to mention that according to the author of this pattern, the most ideal criteria for defining the patterns that give the highest percentage of success is when the first retracement, or point B, is located exactly at the 50% Fibo retracement of wave XA, and also point C at the 50% Fibo retracement of wave AB. Of course, as with previous pattern, we set pending orders. In this particular case, it would be a buy limit order. Also set stop loss and take profit, and waiting for the market to react. The following example we will explain is the bearish bet pattern. The rules are clear. As you can see on the drawing, all is the same as with the bullish pattern, just now all takes place in a downtrend. We will shortly repeat all the rules. First and foremost, we are searching for this pattern in a downtrend. If we found this pattern in a growing trend or at the top of a particular wave or trend, we will stay out of trade. The pattern is defined by 5 points, where the most important point B is expected between levels of 38.2 and 50% Fibo retracement of wave XA. Point C has a range of movement between 38.2 and 88.6 Fibo retracement of wave AB, and the level of entering into position, which is point D, is expected at the level of 88.6 Fibo retracement of wave XA. At this level, we set pending order. In this case, it is the sell limit order. Stop loss is set at 1.13 Fibo extension of wave XA, and set take profit at the minimum double level compared to the stop loss. This pattern is very present in our trading, often appears on the chart, and it often happens that provides multiple higher profits compared to the risk. Shark pattern is the third pattern that we use in trading and that we will now explain. This pattern has significant differences from the previous two patterns and are primarily reflected in extension waves. As you can see on the picture, those are waves BC and CD. In the previous two patterns, first critical point that determines the pattern is point B. While here this is not the case. As we can see, point B has a wide movement field, and it's between the Fibo retracement of 38.2 and 61.8% of the wave XA. The most important point of the pattern, and the point that defines this pattern, is the point C. As you can see, point C exceeds the point A. This tells us that BC wave is extensive wave. Depending on how much the wave BC or point C is higher than the point A, we define the pattern. As for the shark pattern, this extension must be between 1.13 and 1.27 Fibo extension of XA wave. So how do we measure this extension? We use Fibo tool, stretch out Fibonacci from point A to point X, then extensive Fibonacci levels will be displayed on the chart. But for us, the important levels are 1.13 and 1.27, when we talk about the shark pattern, of course. If the wave BC ended between these two levels and the price start to form wave CD, then we can confidently say that it is a shark pattern. Of course, pattern is not complete at point C. But as you know, we have to wait for the pattern to be formed to the end, and a pattern is completely formed at the point D. Where do we expect point D? Right below the point X, and the level that is expected and where we enter the position is exactly at the level of 1.13 Fibo extension of wave XA. How do we measure and mark this level? Well, use Fibo tool and stretch out Fibonacci from X to point A. Then we mark the level of 1.13, and at that level we make entry into the position. Of course, before the price gets to that level, we advise setting pending order because we do not want to miss a trade. As we said, it is very important to know how to use Fibo tools so you can measure this retracement and extensions. If you're not familiar with Fibonacci tool, return to one of our previous lessons where we explained Fibo retracement and extensions. Next, we will explain the levels of take profit and stop loss. We set stop loss at a level of 1.414 Fibo extension of wave XA. This level is measured at the same way like the level of entry in the position, meaning stretch the Fibo tool from point X to point A and mark a level of 1.414. If you do not have this level of Fibonacci, insert it through Fibo properties as previously explained. Take profits, set to a level at least 2 times higher than the stop loss, and move it according to the movement of prices. The risk per trade is 1%. Bearish shark pattern rules are the same as for the bullish pattern, only it is a reverse pattern. It means that you are looking for it in a downtrend. If the trend is stronger, it's better, but we said that if one or two lower tops occurred, we can expect that there will be a trend reversal, and then we can set sell positions based on this pattern. Point B is not as important in this pattern, and it is only necessary to make a return of a minimum 38.2% of wave XA and should not exceed the level of 61.8% Fibo retracement of wave XA. Point C is the most important point in this pattern, and it must be located between the two levels of extensions of wave XA, and those are levels of 1.13 and 1.272. If it comes to creating the fourth CD wave, set pending order at the level of 1.13 extensions of wave XA, and also at the same time should be set up stop loss and take profit. As for the shark pattern and in general our experience in trading with this pattern, we can say that the pattern has a few flaws. These flaws are primarily that it is quite rarely seen in the market and it does not have a great success rate. It can easily go from one to another losses in a row by trading using this pattern. But then why using this pattern in trade? Well, for one simple reason. When all goes right and when the price goes in the right direction, the profit per trade can be far higher than the expected risk. So this pattern does not appear so often, but when it does, really big profits can be gained. Cypher pattern is the last that we use in our strategy. The first half of the pattern, that is the first triangle which is marked with points X, A, B, is identical to the shark pattern, while the other is significantly different. Let's start from the beginning and explain the whole picture. These smaller waves represent growing trend and they are displayed by higher peaks and higher bottoms. What does this tell us? It tells us that we will enter into the buy position in a growing trend and into the sell position in a declining trend. So the first thing you do when you open platform is to see what trend is it. If you find some of the harmonic trading patterns on the hourly graphics, H1, then make sure to check the trend on the H4 graph. If you find a pattern on the H4 graph, check the trend of the movement of prices on the D1 graph. Moving on, we said that the first part is the same as in the shark pattern, which means that the point B does not have such importance for defining this pattern, and it has a range between 38.2 and 61.8 Fibonacci retracement of wave XA. The next point is C, which is the most important point in pattern, and based on it we determine the pattern. As we can see, a wave BC is extensive and has a range between 1.272 and 1.414 Fibonacci extension of wave XA. So, what do we do when we find a formation on a graph that remind us of some of the harmonic patterns? First, we measure the first retracement, which is point B, and we can mark point XAB. Then measure the point C, which is extensive. For this, we will use the Fibo tool and stretch Fibonacci from point A to point X. This displays the extensive levels of Fibonacci. If you do not see them, you will have to answer them. As far as this pattern is concerned, for us now the only important levels are 1.272 and 1.414. If the top of the wave BC or point C is between these two levels, we know that it is a Cypher pattern, and then we are looking for entry level into position, which is marked by point D. Point D in this case is the level of 78.6 Fibonacci retracement of wave XA. So we stretch Fibonacci from point X to point A, mark the level of 78.6, and here we make entry into the position. Of course, we set pending order before the price reaches that level and wait for the market to open it. Now, how to set stop loss? Just use Fibo tool again and stretch it from point X to point A. We mark Fibo extension of 1.13, and at this level we set a stop loss. Once we have determined the stop loss, take profit is simply determined and just put on a level that is at least 2 times higher than the stop loss. And if the price goes in the desired direction, we move the take profit and stop loss in order to reduce risk and ensure profits. The risk per trade is 1%. Entering into position, stop loss, take profit, and risk per trade, we adjust at the same time using pending orders. This is very useful because if you make a mistake, for example, if we enter too big lots per trade, we will simply edit the pending order, modify it, and save the changes. Bearish Cypher pattern rules are exactly the same as with the bullish Cypher pattern rules, and we will not repeat them. We will only point out the most important condition that needs to be followed in trading with this pattern. Of course, and with bearish pattern, the main point is point C, which must be in the range between 1.272 and 1.414 Fibonacci extension of wave XA. That would be it for the trade rules with these 4 patterns that we use in our strategy. You can use all of these drawings as a reminder for trade until you will learn it. The next step are some examples of our trade that we have in last period. Of course, we will present some of them just to see how it looks at the graph, and after that we'll show you live trading on the real account. Based on these examples, you will have a much clearer picture of the harmonic patterns. You will see that the graphics represents exactly the same situation that we explained in previous lessons. The difference is that it will be displayed on the real price movement of financial instrument. So if it is still not clear all about the extensions and retracement on the basis of which we determine the important points of patterns, we are sure that you will realize how this strategy is simple when we show you live trading on the real account. Hello everybody and welcome to the live trading on the real account. We found an interesting situation on the movement of the currency pair American dollar, Russian ruble. It is this last movement, these last four ways to be precise. First, we need to determine the trend. On H4 chart is a falling trend, which means that we are looking for sell position or a bearish pattern. So we look at these four waves, first, second, third, fourth. Since the third wave exceeds the bottom of the first wave, this means that it is either the shark or the cipher pattern. Using Fibonacci, we can determine which one it is. So we stretch Fibonacci from the bottom to the start of the first wave. We can see that the extension of the first wave, or point C, occurred right between the levels of 1.13 and 1.272. If you forget, you can always go back to the rules that we explained. So if the wave BC or point C is between 1.13 and 1.272, it is a shark pattern. For bearish shark pattern, entry level into the position is the extension of 1.13 of XA wave. We market that level as a minus 13. If you do not have this level, just stretch the Fibonacci now from the start to the bottom, which means from the beginning to the end of wave XA. We will mark that level, and for us that is a level of entry into position. Stop loss is an extension of 1.414. We will also mark that level, and take profit is at minimum twice as high compared to the stop loss. We will determine it roughly, let it be this level here, and later we can move it. Okay, now we'll mark all the essential elements of this pattern. And a potential point D. Since we have all the essential elements of the pattern, it is still necessary to place pending order. Click New Order button in the Type field, choose the pending order. As we enter into sell position, choose Pending Sell Limit Order. We simply set the stop loss, take profit, and at the price field, reading the information from these blue lines. The top line is the level of stop loss, which is 58.41238. Take profit is the bottom blue line, 57.56928. And entry into the position is set at the level of 58.14387. Click on the place, OK, and the position is set. In our trade, the risk is about 1% compared to the total account.
How much will you risk depends on you and on your strategy, but we advise that it does not exceed more than 3% risk per one trade. Okay, position is open. Now we can only wait and hope that the price will rise to open a position and then fall. Talk to you later. Few hours later, we return to live trading as we can see the price rised, opened our position and continue moving in the desired direction. Since we are trading using trailing stop, we move stop loss when the price falls to the level of stop loss in order to ensure trade from loss, which we are going to do now. Stop loss is about 25 pips and the price dropped close to 40 pips, which means more than level of stop loss. Now we need to click on the red dotted line and move it to the level of entry into the position. Then click on the modify box, OK, and that's it. What we have done so far. We have ensured our trade of loss. We cannot lose, but we can earn if the price continues to fall. Take profit is on 2% of profit at the moment, and we will also move it. Since the stop loss was 25 pips, we will set take profit at around 3% in profit, which is about 75 pips. That is this level here. Click on the red dashed line and move it to this level here. Modify, OK. Now we just need to wait to see what will happen next. As we can see, price is very near to our take profit. We decided not to move take profit, but to take 3% of this trade. We have two reasons for this. The first is that price is at the same level for more than half an hour, and this is level of 61.8. Another reason is that today are expected some important news regarding US dollar, 2-3 bulls and a few 2 bulls. This news could have a big influence on the movements of the dollar, and for this reason we decided not to risk but to close this position at 3% of the profit. We'll wait a little longer to see if the price will be able to drop a few pips and close this position. We leave it as it is. What we needed to happen is that the red line, ask line, pass through take profit. Only when that happens, the position will be closed. This is it. As we can see, pending order is closed. We no longer see the dotted line, which means that trade is over. Let us repeat. With only 1% of risk, we took 3% of profits. This was a successful trade. We have achieved a profit. We will look further for positions on the stock market and show them to you. Bye. Hello everyone, we are again in live trading on the real account. Now we found an interesting situation in the movement of Daimler stocks. That is this movement that resembles on one of the pattern of harmonic trading method.
the first thing to do is to determine the trend. As we can see, there is a strong upward trend recently. For patterns beginning, we take this last point on the trend line. Since the third wave, the wave BC, does not exceed the peak of the first wave, means that these are the bat or the Gartley pattern. With the help of Fibonacci, we will determine the pattern. Fibonacci is stretched from the beginning to the end of wave XA. We can see that the first retracement occurred exactly at the 61.8 Fibo retracement. Since the first retracement occurred at a level of 61.8, it means that this is a Gartley pattern. For Gartley pattern, we said that the entry into position or point D is at a level of 78.6 Fibo retracement. So this would be our entry level into position. Now, as the price is pretty close to that level, we can lower a bit down the entry level position because the platform might not let us play the position. So we will set the entry level at about 88.6 Fibo retracement. Moving on, we need to determine the level of stop loss and take profit. As we said, stop loss is set at the level of 1.13 Fibo extension of XA wave, and it is this level here. Take profit is set at least 2 times higher than the stop loss. If our stop loss is about 70 pips, take profit will be at least 140 pips. It is roughly this level here. We'll put it this Fibonacci level. We can also adjust it later. We will mark all the important points of patterns and then we set the pending order. And a potential point D. After we determined all relevant levels for pending orders, these are the 3 blue lines, now we'll set it up. We will click on the button New Order. In the field Type, select a pending order. Since this is a bullish Gartley pattern, we will enter a buy position. Choose the buy limit order. First we set the level of stop loss. It is this lower blue line, 68.914. Take profit is this upper blue line, 71.291. And the level of entering into the position is 69.648. Place OK and the position is set. Delete all unnecessary lines, the trend line and the 3 blue lines. We will delete and Fibonacci also. Now we can only wait and hope that the price will fall and will open the position. Talk to you later. We're back to the live trading. We returned only to show you that the position was opened. This single candle that made the largest fall was enough to activate our position. Now we only need to wait. If the price goes in the right direction, we will move the stop loss to ensure trade from loss, or later if the price jumps we will ensure a certain level of profit. Currently the price is not moving because the stock market is closed. The stock market is not open 24 hours a day as Forex, so we'll have to wait until tomorrow to see what will happen to the movement of Daimler shares. Talk to you a little later and we'll see what happens with the open position. We're back in live trading and see that the price after the opening made a significant jump. Since our stop loss is about 70 pips and the price also jumped around 70 pips, this means that we earned about 1% of profit. Since we use trailing stop, we will move our stop loss to entry level into position, and in this way we will insure against loss. You only need to click on the red dotted line and move it to the level of entry into the position. It is necessary to enter modify section and click OK. In this situation, we cannot lose anything, but we can earn if the price jumps. That's it for now. We'll get back later to see in which direction the price will move, and then we will decide whether we will take profit at the same level, or we might even move it up, hoping that we will achieve higher profits. It paced more than 2 days from the time of opening to closing time of the position. As we can see, the price made a huge jump. Unfortunately, we did not take advantage of such a large increase, but the price closed our position at take profit level. Since the price stayed at about the same level for 2 days, we did not want to move take profit and left it on the same level. Now let's see what happened. Let's also review the levels of entry into the position, stop loss and take profit. Entering into position was made at a slightly lower level than the 78.6 Fibo retracement. Stop loss was at the level of 1.13 and take profit was twice the stop loss, and it was this level of Fibonacci. When the price jumped, it closed the place pending order and our trade is finished. So we invested 1% and we achieved 2% of profit. In any case, this was a successful trade, although the price made a big jump and we could achieve a lot more money. Do not ever regret if this situation has occurred and expect much higher profits next time, because it is very possible that that will not happen. Open, the price will reach the level of your take profit or pattern high and then return and you will lose potential profits. What is important is to respect the strategy rules that you use, to respect the levels of stop loss and take profit, and not always target extremely high profits. This should be done only in a situation when we have the support of fundamental analysis, when we have a strong jump or fall of the price, not like here. The price was almost at the same level for a long time and then made a significant jump. Also on this previous trade, a significant fall occurred. We could have achieved higher profit than the one we did, but that really does not matter. It should be happy with any achieved profit. In any case, this also was one successful trade. We will continue to looking for positions, and if we find something interesting, we will try to record it and present it to you. Bye.
Hello everyone, we're again in live trading on the real account. We found an interesting situation on the movement of a market index Standard & Poor's 500. It is interesting because the pattern that we noticed observing these last four waves is in the uptrend, and this is a bearish pattern, a sell position pattern. We decided to set the pending order for one reason. Let's first take a look at the trend. Definitely that was a strong uptrend, but this last movement that we see gives us an indication that in the near future there might be a reversal of this uptrend. Why do we say that? In the part of the course when we talked about what defines the growing trend and what gives an indication that there may be a trend reversal, we said that the growing trend considers those trends when charts show constant higher peaks and higher bottoms. And an indication that there will be a reversal is a situation when the charts show the first bottom lower than the previous. This is the situation here. So we have a bottom first, second, which is lower compared than previously, and also we have one peak which is lower than the previous. What does this tells us? This tells us that the price does not have the strength to keep going up. Otherwise, we wouldn't play this pattern in such a strong trend, but at this time we decided to take a risk and take advantage of this opportunity. Why? Because in this situation, if trend reversal occur, it is possible to achieve huge profits. Here is a hyper bearish pattern. How do we determine that? First, we see that this third wave is lower than the previous, so it's the either hyper or shark pattern. With the help of Fibonacci tool, we'll determine which one is it. We stretched Fibonacci from end to beginning of the first wave. As a start of first wave, we take this point here. That is the top of this candle. It wouldn't be a mistake if we took this level here, but this time we decided to take this point here for X point. The only difference is that we will enter the position earlier. We therefore stretched Fibonacci from point A to point X in order to measure the extension of the first wave, XA. The extension is located between levels of 1.272 and 1.414. Since the extension took place between these two levels, it is a hyper pattern. Entering into position in the hyper pattern is made at the level of 78.6 Fibo retracement. We stretch Fibonacci from point X to point A and mark level of 78.6. Stop loss is set at the level of 1.13 Fibo extension of wave XA, and take profit is set on this level here, and it should be at least 2 times higher than the stop loss, but this time we will go higher. Once we have identified all the essential elements of the pattern, we can draw the pattern to be clearly visible, mark all the important points of pattern, and set pending order. Now we are going to do that. and a potential point D. Now we set the pending order. Click on the button New Order. In the field type, select pending order. Also select sell limit. Stop loss represents this upper blue line, 2388.81. Take profit represents this bottom line, 23829.73. And at price is the middle blue line, 2372.6. Click on the place button, then OK. OK. Delete blue lines. Our position has been set. Now we have to wait and hope that the price will rise a little more, open our position, and then continue in the desired direction. We're going back to see what happened here. Price came very close to our position order, but not enough to open our position. After that, it made a significant fall, and our pattern is not longer valid. We intentionally wanted to show you this situation. The reason is that this situation often occurs on the stock market, and when it does, be sure to turn off the pending order. A pattern is lost because the structure has formed the fifth wave. Point D is also formed, but not at the level that we wanted. But there is nothing more to do. This situation often happens, and now it only remains to delete this pending order. Click twice on the dotted green line, then delete button, and OK. That's it. Talk to you later. Hello everyone, we're again in live trading on the real account. We found an interesting situation in the movement of the currency pair US dollar Canadian dollar. It is here in these last four waves. The first thing that we need to determine is the trend. This pattern is obviously bearish, which means it provides signals to sell. And if we want to play this position, it is essential that the pattern is in a downtrend or the sideways trend. Let's see what kind of trend is it. We're moving on H4 graph to see the trend on a larger time frames, since we cannot clearly determine the trend based on this. We can see that the last movement has a lower peak than the previous and a lower bottom compared to the previous, and we can play sell position. We will return to H1 graph. Using Fibonacci tool, we will determine the pattern. Since the third wave does not exceed the bottom of the first wave, that means that it is either the bat or the Gartley pattern. We'll take Fibo tool and stretch it from the top to the bottom. Now we can see that a wave 2, that is point B, is at 50% Fibo retracement. This clearly shows that it is a bad pattern. For this pattern, the entry into the position is at the level of 88.6 Fibo retracement of wave XA. Then stop loss is set at 1.13 Fibo extension of wave XA, and take profit is set a minimum twice the level of the stop loss and can be adjusted later. We'll delete Fibonacci, draw the pattern, and mark all its essential elements. After that, we can set a pending order. Click on the button New Order. In the field Type, choose Pending Order, then Sell Limit, and fill in the blanks. Stop loss is this line above, 1.34841. Take profit is this bottom line, 1.32767, and entry into position is this middle line, 1.34269. Then click on the place box and OK. That's it. The position is set. Now we have to wait to see if the price will rise and open a position. Shortly after we return back, as we can see, the price rised enough to open the position. We'll wait to see what will happen next. Soon we're back in live trading. As you see, the position is closed, sadly not the way we expected. The price rises and closed the position with a loss. Now let's take a quick recall what we have done here. So we found a pattern for sell. It was a bearish bet pattern. So we set the pending order at 88.6 Fib retracement of the waves XA. Stop loss was set at 1.13 Fib extension of wave XA, and take profit we set somewhere around here. What happened then? The price rised, opened the position, but after that did not continue in the desired direction, but continued to rise and reached the level of stop loss. When the price hit the stop loss level, that closed the position. In any case, we do not regret for playing this trade. The pattern was good, and if this situation repeats and forms a similar pattern, we will play it again. We will continue to look further for new examples to explain. Bye. Hello everyone, we are again trading live on the real account. We found an interesting situation observing the movement of shares of Deutsche Telekom. It is this last movement, this last 4 waves. First, second, third and fourth. Since the third wave is extensive and exceeds the top of the first wave, it is either the shark or the cyper pattern. Using Fibo tools, we measure extension and determine the pattern. Since the extension of the first wave, which is the point C, is located between levels of Fibo extension 1.272 and 1.414, it's a cyper pattern. This is of course a bullish cyper pattern. Since we intend to enter a buy position, it is necessary that we are dealing with uptrend. So we will see is that the situation here. We can notice that in recent times there is a strong uptrend and we have the green light to play this position. We will return to H1 graph. For cyper pattern, we said that entry into the position is made at the level of 78.6% Fib retracement of wave XA. We will mark that level. Stop loss is set at the level of 1.13 Fib extension of wave XA, and take profit is set at least 2 times higher than the stop loss. We'll place it here and adjust it later. Now we have marked all the important elements of this pattern.
and a potential point D. Since we have all essential elements for setting pending order, we will do that now. Click New Order. In the field type, choose Pending Order. We also choose the buy limit and fill in the remaining blanks. The blue line below represents stop loss, which is the price level of 15.783. Take profit is this upper blue line, 16.271, and the entry into position is set at the price level of 15.970. Then click on the place box. OK, that's it. The position is set. We can now only wait and hope that the price will fall, open our position and continue in the desired direction. Talk to you later and we'll see what happens with this trade. We're going back, the price has fallen enough to activate placed pending order. It took more than 3 days for this to happen. Anyway, now we are in the open position and still waiting to see what will happen next. Price has started rapidly to move in the direction that is not good for our trade, so we hope that it will return and start to grow. Talk to you later. We are back again and we can see that the price rises and now we have position in profit. In this situation, we should move the stop loss to ensure against loss. We will do that by double click on this green dotted line, and now in this window here we can set the stop loss and take profit. We will change the stop loss and take profit. Since entering into the position was at the price level of about 16, stop loss will be moved at approximately the same level. Take profit will roughly move and place it on the price level of 16.5. Click on this arrow and enter 16.5. Then you only need to click on the modify box. Now let's see what we have done. We moved the stop loss around the level of entry into the position, which means that if the price returns, we will end this trade safely without loss, even with a small profit. What is important is that we certainly cannot lose anything in this trade. We also rise it take profit at around the level of 3% in profit, and we will continue to rise it if we consider that the price may continue to rise. We will continue to monitor this position and will note you if we change anything or if the position close. We return only briefly in order to show you how to manage the position when the price make this big lap. Since we have earned in this position more than 2% of profits, we will ensure 1%. How we do that? We set the stop loss at entry into position. So now we just move it up and ensure 1% of profits. Now let's see what this level should be. So if the stop loss was here and it was around 17 or 18 pips, that is this level here. Now we're going to determine which price level that is, and that is 16.125. Okay, now we'll delete the Fibonacci, then click on the green dotted line and modify the stop loss. It is currently at the level price of 16 and we will then set it on 16.125. Click on the modify box and OK. We notice that the stop loss moved and now we ensure 1% of the profits. If the price starts to fall, we will end this trade with 1% of the profits, and if it rises to the level of take profit, we will earn about 3%. Back to the live trading, as you see, the position is closed, fortunately for us with the profit. The price rised more than enough to open the take profit order and close this position. So what have we done? We found a pattern, bullish cipher pattern. We set the buy pending order at this level here. We made entry into the position. After first the price began to fall but did not reach the stop loss that was at about this level here. After that the price has made a huge jump with a big gap and we were in profit. Then we moved the stop loss in order to ensure our trade from loss. After that we pushed up take profit at this level here, about 3% of the profits. Then we ensured 1% of profits, and there was nothing we could lose, and in the worst case we would have earned 1%. Yet the price continued to rise, activate our take profit order, and the position was closed. We did not want to continue to push the take profit more because these three previous stops, first, second, and third, are at about the same levels and presumed that the price won't be able to break that level. So we did not want to risk more and we decided to take a 3% of profits on this trade with only 1% of risk. Anyway, this has been a successful trade played with the Deutsche Telekom shares. Bye.